righty, ladies and gentlemen, boys and girls, we're here for the big show. Grizzle Commodity Con is now live.
Welcome. We got a stacked schedule. Thank you for joining us, man. It's a full day. We're going from 10 a.m. right to 3:30, 4 p.m. Guys, give it a like, give it a retweet. Let the world know. We got a big guest up next, Kuppy. But first, I got to thank our partners in the stream. Hold on, I'm gonna mute something here. All right, guys, a big thank you to our partners. KEDM, find inflection points for your returns and track 20 plus event-driven catalysts with Kuppy's event-driven monitor. Learn more at KEDM.com. Goehring and Rosenzweig, natural resource investors, respected thought leadership and groundbreaking original research. Visit GoRosen.com to learn more. Doomberg provides salient insight on energy, finance, and the economy at large. Visit Doomberg.substack.com to learn more. And finally, the GRZZ ETF, risk managed exposure to the growth themes of the future. Everyone,
all right, yeah. Thanks to our partners, everyone. Now, what you guys are going to get today, buckle up. We got a jam-packed schedule of leaders, asset managers, asset allocators, where they're putting their money, where they see the opportunities in commodities. We've all seen how well commodities have done this year. It's been really the only bastion of the market volatility, but it's a big sector, right? So if you don't know where to put your money, this is going to be the stream for you. So
exactly. And so without further ado, let's get Kuppy on here, man. Kuppy.
All right, let's play.
Hey, guys!
You are mine, my friend. Welcome to Commodities Con.
Oh man, we got a living legend right here, man. If there's someone who mixes it up the best on Twitter, it's Kuppy, man. Kuppy, thank you so much, man. A pleasure to have you on.
If you read my Twitter, I probably offended you, so sorry.
Dude, that's Twitter. It wouldn't be Twitter, right? We're not offending each other.
Well, if Kuppy hasn't offended you, chances are, you know what I mean? Kuppy's giving you, you're not giving, you give it to them real, man. And if people can't handle the real, so be it, you know? And right now we're living in Project Zimbabwe. Kuppy, talk to us about it. We're like right in the main event. As you published, your original Project Zimbabwe piece was like 2020, I believe, right? Or you may have been pontificating about it a long time before that. Talk to us about where we sit right now, because it feels pretty damn Zimbabwe-like.
Well, I got my shirt on today, in honor.
I thought you might have your wheelbarrow full of cash too.
Oh, love it.
It doesn't feel very Zimbabwe today. I mean, all my commodity stuff's melting. But this is part of the process. If you look, the Fed printed too much money. They created a crack up boom. And then people started complaining, No one was upset when the price of shit coins and, Ponzi stocks went up. But then they started complaining when the price of broccoli and tomatoes and oil went up. And so, the congressmen all called Jay Powell and they said, do something. And he's got two knobs. He can print, he can QT, or he can change the interest rates. And he's doing something now. And the net result is that he's going to break some things. I mean, the history of the Federal Reserve is that they overstimulate and then they panic about inflation and they break stuff and the cycle starts again. And we're at the part of the cycle that's going to really suck. And they're breaking stuff. And the question is, when do they panic? And you want to buy that kind of like couple week window when stuff's breaking right before they panic. Because once they panic, then everything just goes straight up again. And I don't think we're there yet. I mean, I took my exposure down a lot last year in the fall and in the spring of this year. But I think they're going to panic in this fall because stuff's starting to break. I mean, the credit markets are starting to freeze up. The mortgage financing market's freezing up. The consumer spending numbers are abysmal at all the retailers. They're going to panic and they're going to start printing money again. It's a cycle. It's repeating. The difference this cycle is that oil is driving the bus and the Federal Reserve is kind of along for the ride. And I don't think they've realized that yet, or maybe they have. I don't know. But they're just going to chase oil higher. And the problem is that demand grows every year because population grows and population gets wealthier. And there's 6 billion people who want the same standard of living that we have. And many of them, don't have a refrigerator right now. Like their energy consumption is going to go up dramatically over time. And that energy has to come from somewhere. And between ESG and the government getting in the way of permits and pipelines and Biden playing whack-a-mole and just basically canceling all sorts of stuff everywhere, like where's it going to come from? So the price goes up to destroy the demand side, except for they keep giving energy stimmies, and then, so the demand side doesn't respond either. That's why oil just keeps going up.
Well, you mentioned, you talked about that, and that's a real dynamic here where, of course, the brakes can be put on if oil gets too hot, but if you're doing stimmies on the other side, right, and God knows what other countries, emerging market countries will do the same, but this is, it has a feeling, I guess, ultimately, how do you see it, Kuppy, in terms of assuming that the status quo of them trying to cushion this, and that at the same time, not letting drilling happen, not incentivizing the supply side. How do you see this playing out over the coming months, years?
Well, we're going to have an energy crisis. That's what's going to happen. Energy is going to go to some crazy number, and it's going to wreck everything else. Every non-energy QSIP is going to get murdered. I don't think you want to own anything but energy.
Brutal. It's tough. And so looking across the commodity complex, is anything? So let's break down energy, right? Do you have a preference to oil, natural gas, coal? Are you preferential to electricity or petroleum that goes to fuel things to move?
Oh, I think they're all going up.
Just win.
If you look at the energy complex, you can switch between the different inputs, and there is some switching going on right now. I mean, one of the reasons that oil is so strong is that nat gas went up, and they're burning fuel oil for electricity instead of nat gas. And look, there'll be some switching back and forth. You just want to be long energy. If I had to choose, I just like oil. And then I like uranium because they've adopted this kind of green religion, and it's not supposed to make logical sense. But eventually they'll find a new messiah, and that's going to be uranium. And they're going to go to nuclear because it's the only base load that doesn't have carbon. And it just seems inevitable to me.
And I guess Europe right now, that this is it's coming to roost right now, right? They're in such a crux with respect to. I guess we should talk about the big story, right? You've been on top of the Russian, the Russian story, Russia Ukraine. How does this play out? It's almost like we played every card completely wrong. If they were trying to break Putin, they've actually pumped him up. Just look at the ruble,
and look at exports of oil are at all-time highs from Russia. So not working there.
What's the? Maybe you could, obviously, you're closer to most on the Russia on Russia. Maybe give us some thoughts on how you see this playing out from an energy perspective, and also how Putin wins or maybe has to step back from the chessboard.
Well, I mean, let's start with saying it's a humanitarian disaster and it's terrible we have a war. But in terms of Putin, I don't know if he even wants Ukraine. I don't think the Ukrainians want those two provinces. I don't think he wants those two provinces. No one really wants anything to do with them. They were just a bait. And the U.S. And the rest of Europe stepped into the trap. And he's going to spring the trap this fall when Europe really needs nat gas. I mean, they really should get every able-bodied German out there and get them to go chop some firewood because it's going to be cold.
Oh man, it's gonna be a hell of a winter.
That's for sure. It really will. But no, I mean, he spent a decade thinking about this, and everyone walked into a trap. He controls multiple inputs, whether it's nat gas or coal or steel for the tubulars for U.S. shale, or whether it's uranium and enriched uranium and fertilizer. And he's just going to play his little piece on the chessboard in an opportune time. He didn't just drop the hammer. In a 1 week window, we did sanctions on damn near anything in Russia. He's being really opportune about this, and he's going to kind of squeeze and prod and play games. And Meanwhile, he's going to choose who his friends are. India wants some oil. He'll pry India away from their relationship with us. He's just going to be very strategic and intelligent. I think, if you look at how stupid the battle plans kind of unfolded in Ukraine, I really don't think they intended to win the thing. I really do think it was bait. And Putin's winning now. He's winning by a lot. And meanwhile, the U.S. has an energy crisis, and we're banning drilling and canceling pipelines still. And now they're talking about excess profits tax. And, no one wants to go drill a well if you don't think you're going to earn any money doing it. The next thing they need to do is threaten to nationalize it, because that'll really increase production.
That'll fix all our problems.
Yeah, it's great.
Yeah, that'll fix all the problems.
Just on that, I guess the whole windfall taxation. It's incredible. I guess for me, just having gone through the last energy, the shale, all the excess drilling in shale. It's incredible how much how much they've held back. Are you kind of surprised how corporates are kind of all towing the line to say, "Niet, we're not gonna pump barrels, until we have better visibility," or do we hit a point where supply just on the private side, or could there be a surprise here that we're not?
Yeah, can they not help themselves? We've seen in shale, they see free cash flow. They can't help themselves sometimes. They drill or they buy. Like, do they hit that point?
No, I think the last cycle, they were saying the Permian break even is 35. In reality, it's probably like 50 or 60. All the costs have exploded now, whether it's labor or downhole steel or cement casings. Frac sand's in a bull market. Like, when's frac sand ever in a bull market? And
it's been a while.
Let's say the Permian was 60 break even. Now it's like 80. But their cost of capital went up. So to earn an appropriate return, you need like 100 to want to drill. Then you look at where oil is for 2023, because if you want to go drill a well today, you're probably not going to get to production until Q4. And, you kind of have a type curve and everything. Like, so you want to go hedge it. And, 2023 oil's in the high 80s. You go out to 25, it's in the mid 70s. So your bank is going to lend you money, and for, you're going to be producing this thing below break even by 24. So, like, why would you, borrow money at really expensive debt? You probably can't even get bank financing because the banks are all cutting back. You have to go to some scumbag hedge fund that wants warrants and, something else. And you can't even produce the thing profitably. So no, and that's like the lowest cost base. And I think people really were deluded when these energy companies lied and said that they produced it at 35, because oil was sitting there between 50 and 70 for half a decade. These companies burned capital and destroyed money. So, that's kind of a sanity check that it really wasn't break even at 35. Continue.
No. Sorry, keep going. No, but it's a great point. Like, if you ever look at any of the return on capital employed, like it was zeros, goose eggs across the board, and that was a best case scenario, mostly negative. And it was debt fueled, right? And I guess that's the side that you're not seeing, that debt fuel side of this coming back, right? You're not getting that exuberance on the debt side for oil and gas.
No, you have to cash fund it. Remember, a lot of these companies aren't even very cash rich. They locked in their hedges a year or two ago, and they're producing into hedges that are in the 60s and 70s. Like, remember, their break evens are like 80 right now. So they're still destroying capital as we speak, which is why they don't have the liquidity and the balance sheets to go forward. Eventually they will, but there's huge bottlenecks everywhere too. Look, we've had, in 2008, we had an oil crash. In 2014, we had an oil crash. And in 2020, we had an oil crash. So in a 12-year period, we've had 3 of these things. And if I was an oil field worker, I'd say to hell with it. I don't want to get fired every third year. So these guys have all gone into construction. They've gone into other trades that are much more stable. They pay better. You get to be close to your family, building homes or building, whatever it is, your strip malls, whatever you're building. But you can drive home rather than being in Midland for 3 weeks on. And so, no, I don't think the labor is coming back. And it takes a rather skilled person to operate a drill rig. You need true precision in terms of targeting these layers, and just every component of the process. The shortage of labor is the shortage of drill pipe, frac sand, like downhole tubulars, like everything you need, the shortages of, and there's no one producing the components either right now. It's going to ramp up slow in the U.S. If you look, I think most of the ramp this cycle is going to be offshore in countries that don't really care about carbon because they just need the dollars. It's going to be West Africa. It's going to be Brazil. It's going to be Guyana and Suriname. And I mean, look, Namibia just had a huge find. Like you go drilling for oil where all the big finds are, and these guys are gamblers in the end. I think oil offshore is going to be where you see a lot more future production growth.
So you're still bullish on the offshore oil being a source of supply?
Oh, absolutely. It's the only place, really. I mean, in the end, like most of the onshore stuff has either been discovered or it's in funny places where you don't want to go invest. I mean, if you can't drink the water, you probably shouldn't invest. And
that's the line from Commodity Con.
Well, it's true. I mean, you start putting money in the ground and then they change the rules on you. Though, they do that in America too these days. So who knows? But I would just think that you're going to go to places where you can go offshore because that's where the real big discoveries are going to be. And it's very different. If you go onshore, the local guys say, oh, I could do that, and once you have the well and it's producing, they probably can do it, It's very different to bring a $500 million drill rig and crew it and operate it in ultra deep water. Like they just don't have the skill set. Like West Africa can change the tax rates, but everyone's just going to move their drill rig. And they don't have the skill set to operate it. They just know that they are going to, in the end, have some sort of revenue sharing agreement and let the foreigners operate it. So I just think that's going to be where the future growth is.
Kuppy, so I have a question for you about how you think of energy, given we're in a severe supply shortage on the energy side, but at the same time, we're talking about quantitative tightening is happening and the Fed is going to break something. So how do you think of as you go through that period where something breaks and then maybe they flip-flop and then we're off to the races again? Is energy one of these things where it may outperform on the downside and then we still have a severe shortage? So it's just you own energy through the whole thing, or do you get cute about it? Like, how do you think of the next 12 months if that's what we're looking at?
So I own two things really in energy. I own a bunch of service companies. I mean, I'm not a geologist. I don't want to own the producers. I think, honestly, governments around the world are going to screw over the producers because the citizens get mad that the price of oil goes up. So that's not what I want to own. I want to own the energy services companies, and my energy services companies are just printing cash right now. And they print cash if oil's 90. They print cash if oil's 200. Like, in the end, they're just going to make a lot of money, and I'm in a good spot there. The other thing I own is long-dated oil futures and futures options, and they tend to have a low beta to oil, and it's just not that worried about it. I mean, I bought the 100 calls for December of 25. I paid about $2 for them. They're kind of like 8 bid at 9 right now. They trade like 5 a day, and I've got a lot of them.
Corner the market.
You are the market.
I am the market. Yeah. If you look at the vol curve, I've actually kinked the vol curve, which I'm kind of proud of.
That's pretty cool. You got to put that on your wall.
Got a real whale here, man. This is what Grizzle Commodity Con brings. We can bring whales out, man.
Yeah, I kicked the vol curve out 4 years. Yeah, I'm proud of myself. Oil's the largest global commodity, and I kinked it. But in the end, I'm just not that worried about it. I mean, oil equals inflation. I'm long inflation, and this is the best way to be long inflation with not much capital at risk. And on this pullback, I'm buying a bit of USO, let's say, because there's a rolling curve to it, and the roll curve's gotten steeper. But it's just like I'm not really spending a lot of money. I'm more buying some, out of the money long dated calls and stuff like that, and some reversals. And I got my butterflies. You should look at the 200 by 250 by 300 for D's. They're like 25 cents each, and they can pay off $50. That's my trade. I got some of those too.
No, sounds juicy.
Oh, Kuppy, we got a great question online. I'm going to take because.
Okay, let's do it.
A lot of interest here. So I saw you had one of the most salient arguments for being bullish housing. Obviously there's so much negativity on housing right now. You made a point around rents. Question here from Nathan: how about housing for the pivot, or is it too early?
What do you mean by housing for the pivot?
I guess
betting on housing,
betting on
appreciation in housing.
I'm not
anything.
So interest rates, I think, are not going back to zero. I think they're going. We've had a 40-year cycle of lower rates, and the turn is in, and we're going to now have a 40-year cycle where rates increase. That's not a bad thing. I mean, in the 70s, home prices went up 4 times, and rates increased the entire decade. But coming from zero, I don't want to bet on pricing that much, just because, in the end, the mortgage cost will hold down price appreciation. I want to bet on volume. I believe strongly that a lot of people are going to be leaving high tax states. They're going to be leaving the shitty states like California and New York and Illinois, and they're going to be going to the nice states, which is like Florida and Texas and just the whole Southeast. So you have this huge migration. You have a migration from cities to suburbia. The average housing stock is in the 40s right now in the U.S., which is the oldest it's ever been. So you have a lot of, even in suburbia, of homes that need to be dramatically remodeled or more likely just knocked down and restarted. And I just think you're going to see a lot of volume. And I'm long the building materials companies that supply all the components to this, because whether it's remodel or whether it's a new build, I think it's just going to be a huge amount of demand for it, especially with work from home. I mean, it used to be you'd have a little house that was like 1,500 feet. If you look at the stuff they built in the 60s, it was like 1,500 feet, and like the kitchen was shoved in the corner, and it's fine, whatever. But now you look at a house, it's like 6,000 feet on a little 8,000 square foot lot, and it's like 4 stories high, and the kitchen is like this whole big open room in the center aisle. I think that if people go to work from home, they're going to redo the entire design of a house, and I think I just want to be long the components for that. That's how I'm betting it.
Yeah. So, is there an opportunity for home builders just with the low supply we have of houses in the U.S., or you wouldn't play that either?
I wouldn't play that. I mean, look, home builders are going to do just fine, but I do think they're going to have to give up some on the margin to compensate for what's happened to mortgage rates to make the homes affordable. And that's not the place I want to be. And when you look at home builders, you're effectively long call options on land. And, when the cycle ends, those call options are worthless. The balance sheet gets shredded. Plus, when things are going well, they just go buy more call options on land. There's never any buybacks or dividends or anything really to shareholders. It just goes into building more homes next year. It's capital intensive, kind of crappy business. Whereas a lot of the guys producing these components, they're doing 30, 40% return on capital, unlevered capital. You put a turn or two of debt on, and you basically, making 75, 100% a year on your money each year. And that's in the down cycle. And in the up cycle, you do it even better. Like, how would I own the good businesses, not the crappy ones?
Yeah. Kuppy, I got another one on YouTube. Guys, if you are asking questions, go to YouTube. It's way easier to see than Twitter. Got one from Brett. When do we start to see yield curve controls from the Fed? And then he's asking, JGB's 10-year 0.25 cap breaking. That's obviously, Japan's losing control of their yield curve control. Thoughts there? That was one of my questions as well. So how do you see this all playing out, Japan and then on the American side?
Well, Japan's losing control of the yield curve. They're losing control of the currency. They're losing control of everything. When you look at these countries that are commodity importers, especially energy, so Japan, Turkey, I think the technical term is fucked. And they're going to have to respond. And if you let the currency collapse, you can't import the commodities you need. And they're going to have to do something on the yield side, and maybe they haven't figured that out yet. But eventually it's going to break. There's lots of ways these things could break, and usually it's FX first and then yield. But who knows? In terms of, sorry, what was the other question? Yield curve control in the U.S.
Yeah, from the Fed. Yeah.
I don't think the Fed has a plan, really. I mean, you have to look back in time to what was it, 10 weeks ago when they were still doing QE? They were literally doing QE 10 weeks ago. Now they're on QT. QT started yesterday, real QT. They had some runoff a couple weeks earlier. I mean, they're jacking rates 75. Someone asked JPOW at the conference, the presser after the announcement, and they said, why 75? He's like, it kind of felt right. We kind of like sit around, maybe 50, maybe 75, kind of flip the coin. Like they have no idea what they're doing. If I ran a hedge fund and I got every macro call wrong, I'd get fired. If I had an analyst that got 3 in a row wrong, you'd fire him. These guys have gotten everything wrong for 20 years, and they just keep getting inflows. It's crazy.
It's great for you though, right? From a perspective of being on the other side of that, being able to trade off this.
Yeah, look, 20 years ago, I used to buy small little companies that were growing fast, and you could buy these things like consumer products, and they were like 5 times the earnings, and they were growing 30 or 40% a year. It was hard not to make money, and I made a lot of money doing it. And now those sort of companies trade at like 10 times sales, down from 25 times sales last year. And I stopped playing that, and instead I'm just watching the government. And you watch them, you see what they do. And I go out with my friends over beers. We say, these guys are making an unforced error. How do you make money out of it? And really, that's all I do now is just watch our government and a few other very large liquid governments, wait till they make a horrible unforced error, and then just make a lot of money. It's so much easier. If the government says they're going to stimulate the price of energy while restricting the production of energy, then you can have an energy crisis. If the government prints too much money, you can have an inflationary crisis. Like these things are really self-evident. I think the vast majority of finance is obvious. It's really a question of timing. You could have looked at ARC a year ago and said it was a great short, and you could have still gotten ran over for 3 months. I know I did. I was short some. Yeah. It really hurt. It's really a question of timing. It's not what will happen. What will happen is obvious.
You know what, Kuppy, this is like, it's always great a wealth of knowledge, wealth of information.
Yeah, thank you for coming on.
And literally returns, like your hedge fund returns are incredible. Guys, go check out his returns. But more importantly, Kuppy's event-driven monitor, KEDM.com. Kuppy, can't thank you enough for joining us at Grizzle Commodity Con.
Hey, really appreciate it. It's a great idea. Like I said, your timing on Commodity Con is brutal, but whatever.
Off by a week.
What a day.
You're off by a week.
Timing, as you said.
Timing. But in terms of KEDM, go to KEDM.com, take a free trial. We're flagging about 25 event-driven strategies. It's helped me. I can't even describe how much it's helped me. We built it really just because I wanted the data for myself for my own hedge fund. And take the free trial. I don't think you'll be able to trade without it ever again.
Love it.
Amazing. All right, everyone, don't go anywhere. We had a question about thoughts on gold and lithium. Well, we have the CEOs of some of the biggest gold and lithium companies, so we're going to talk about it. Don't go anywhere. Coming up next is Agnico Eagle.
All right, welcome back to Grizzle Commodity Con. Very fortunate to have one of Grizzle's very close friends, Agnico Eagle, Dave Smith. Dave, thank you very much for joining Grizzle Commodity Con.
You are very welcome, Thomas. Good to see you and Scott, and excited to be here.
Thank you. I love the handles.
You brought someone with you, David. Your mustache.
Well,
that is a beautiful
I was in a hockey tournament in Nashville a week ago, playing with some university buddies, and it fit in quite well in Nashville, I got to tell you.
Oh, I bet. Yeah, if you're wearing the cowboy hat, no one they think you live there.
Dave, well, I can't thank you enough. Agnico Eagle, we've had the pleasure of interviewing you in the past, Sean in the past, and always the insights are incredibly wonderful and timely. Obviously, very, very interesting times indeed. We just had Kuppy talk about Project Zimbabwe, but we're going to get deeper into the gold side of this. Dave, inflation is the highest it's been in the last 40 years. Gold has historically been a store of wealth during these periods. It feels like the gold price should be a lot higher. What's holding it back? And are we, in your view, do you think we're on a cusp of a breakout?
Yeah, I think we probably are. I think in the near term, gold's always been a bit of a push-pull, but at the moment, pushing down on top of gold would be the interest rates that keep rising. And historically, gold outperformance has been correlated very strongly with negative real rates. The real rates are now slightly positive, they tell us. And also the relative strength of the US dollar. It's very strong at the moment, and that also pushes gold down. That being said, what's pushing gold up is the other side of that coin, which is the inflation, highest in 40 years, as you say, and no end in sight. But I would add one more thing on top of that. And actually, I caught the end of the Kuppy interview there, and he mentioned the stimulus, the money printing that is coming out of virtually every government on earth, probably, in fact, every one. And from a long-term perspective, it is simple. It's supply and demand. And if there's an infinite supply of paper money and a limited supply of gold or other hard assets, then those other hard assets and gold are going to outperform over the long period. So, yeah, in the near term, it's probably going to be volatile. In the medium and long term, we're completely confident that it will be higher.
Now, so Bitcoin, interesting topic here. Proponents of Bitcoin have viewed it as a competitor to gold, to gold as a store of wealth. Given the significant volatility in Bitcoin, and that's been through the whole entire piece, but particularly this year, the downside, the steep fall year to date. Do you believe we begin to see inflation protection demand, or the money that may have gone to Bitcoin start to come back to gold? Or maybe you could just expand on how you think of Bitcoin as a competitor to gold and just more recent volatility, how that's impacted that.
Yeah, I don't really see Bitcoin as a competitor to gold. I understand the comparison. It's money outside of the control of government, which makes a lot of sense. We all know why we would want that, because there are no responsible governments. But it doesn't behave the same way as gold. And gold's been the store of wealth for tens of thousands of years, where Bitcoin is, I understand, just basically correlated to NASDAQ. So that's not what gold does. As I mentioned earlier, gold is inversely correlated to the US dollar often, but very correlated to the direction of rates. Negative rates are good for gold. And that makes a lot of sense to me as well. Of course, we're looking for stability in our gold investment, and Bitcoin, I would have to say, is the opposite of stable. There's some volatility in gold too. Yeah, but not the volatility in gold is nothing like you'd see in something completely speculative like Bitcoin.
Yeah, it's a great way to sum it up. Now, you run one of the great gold mining companies. We've in terms of operationally, I think very few gold mining companies can compare to what Agnico has done over the decades. from an investor's perspective, what's the advantage of owning a gold mining equity? And I want to caveat that a good one, a good gold mining, because there's a lot of them that aren't that great versus a gold bar.
Yeah, good question. I think that is incredibly important. We see generalist investors all the time. The resource specialist lost a lot of their assets under management in the last blowout in gold in 2013, 2014. And we get asked that question a lot. They do understand gold, or at least they're doing their homework, but they see the gold equities as having a lot of risk, which is true. There's, of course, execution risk, operating risk. There's always some degree of political risk, no matter where you are, as compared to a gold bar. Now, the difference would be that the gold bar, of course, goes in your pillow, I guess, and is uncomfortable when you sleep on it. But it's the same size every day. It doesn't grow. It doesn't shrink. It's just a gold bar. The difference with a good gold equity should be that you are able to grow the investor's exposure to the metal on a per share basis. And I think that's where Agnico has been able to differentiate itself over many decades, is frankly paying attention to that per share part of the equation and making sure that we're giving you more gold for your investment dollar over time.
Yeah, that's a fantastic conceptualization for investors, right? When you think about, and this is really about commodities, right? You always have the choice of owning the underlying commodity or owning a great operator that's producing the commodity, and this is really what it comes down to. It's that production per share, right? And thank you for that. And now, you've recently completed a merger with Kirkland Lake. Agnico Eagle now is the third largest gold producer in the world and the largest gold producer in Canada. How does Agnico's operational risk profile compare to gold mining peers? We've got a good chart here. We can pop up on the screen. But Dave, could you expand on that?
Yeah, this is an interesting question in that. Expanding on the last answer, there is risk in operating a gold mining company. There's a lot of different types of risks. Some of them you can't control. The number one that you cannot or should not, in my opinion, is the gold price. You don't want to hedge your primary product, and largely people don't anymore. Because, of course, if you're going to buy a gold equity, you are looking for the gold price to go up. You believe that if you're buying a gold equity. So you don't want to hedge gold, but you do want to take care of the other risks. And that graph was all about kind of business complexity, manageability. I think it was put together with some mining journal data. And Agnico, again, believes that we can control where we operate, obviously, but we can also control the number of regions that we operate in. And that, I think, is maybe an overlooked part to the manageability and therefore the potential execution at the asset level. Because if you are, managing 15 or 20 countries all over the world, the deepest, darkest four corners of the planet in terms of political risk, well, then logically that is probably going to have more inherent risk than, a single asset producer would actually have some more risk on the single asset side, regardless of where it is. But, if you're in Ontario and Quebec and Nunavut and Mexico and Finland and Australia, like Agnico is, you have good rule of law, you have centuries of support of the mining industry, and you've got supplier networks. And if you operate in those regions for decades, you literally create a competitive advantage. And Agnico's really the only game in town in terms of gold mining in Nunavut in the Canadian Arctic. And we've really developed, over the last decade plus of operating up there, we've developed a competitive advantage that nobody else has. And we can still exploit that while taking care of things like business complexity, manageability, and political risk. So control the risks that you can control, and then just accept the fact that mining is mining, and there are going to be, you're fighting nature. So sometimes things are going to happen in mining, but it's a fascinating business and very rewarding when you get it right. And Agnico's been around for 65 years. And pretty much doing it right for 65 years.
Yeah, without a doubt.
That's
now,
right.
Now, we have one. Your production per share. You've grown this production per share. And your NAV growth. Could you talk about the growth potential from your portfolio of mines and prospective synergies?
Yeah, absolutely. So the synergies from the merger are very significant. We expect it to be about $2 billion over the next 10 years. The most obvious way to demonstrate those synergies is to talk about the Kirkland Lake camp in Ontario, the kind of western half of the Abitibi Greenstone Belt, where we operate in Quebec as well. And it goes over into Kirkland Lake in Ontario. And now with the merger, we basically have that entire camp, including on the western side of it, the operating mine at Macassa, coupling that with Agnico's development projects to the east, like Bidgood, Upper Canada, Upper Beaver being the most advanced, potentially coupling those with the idled Holt Mill to the north, which came from Kirkland Lake Gold. We've got the potential there for infrastructure synergies that would amount to hundreds and hundreds and hundreds of millions of dollars over the years. So we're very excited about advancing that part of the pipeline. But I like to call our pipeline an embarrassment of riches. There's something going on everywhere, and there are a couple of slides in our investor deck talking about the near-term pipeline opportunities, the medium and long-term pipeline opportunities, but these are largely brownfield. And brownfield operations or brownfield developments are really lower risk and typically lower capital and higher return as a result. So tremendous potential east of Malartic at Odyssey. We'll have a study on the Detour Lake expansion coming out in July. I just mentioned that Macassa mining hub, where, again, just infrastructure synergies are incredible with the existing Macassa mine and the Holt Mill. Fosterville over in Australia, heavy exploration budget there and looking for Swan Zone number 2, which was the very, very high-grade zone that they found at Fosterville years ago. Kittilä, we've been operating in Finland since 2009, and that deposit continues to grow and grow and grow. So just huge opportunities there to keep going for decades. And in the Canadian Arctic, expanding at our new Meliadine mine as well. And these are just the near-term drivers. And in the other depth, there's another page of medium and long-term opportunities as well. So I think we can continue growing the shareholders' exposure to gold on a per-share basis.
Yeah, Dave, that's very exciting. And I think we'll have to do a full, thorough open. It sounds like we'll need a long one. Now, if you could take the last minute here, and if we could throw up this chart, because this is a incredible chart on dividend. Could you speak to this? Because this is a real differentiator of why you own a gold mining company, a great one like Agnico.
Yeah, and this is different than the gold bar as well. You're right. The gold bar doesn't pay you a dividend. In fact, when we update this graph for 2022, the current dividend rate would amount to about $700 million this year. So coupling that with our $500 million buyback program that was announced that we're just starting to execute now, we're looking at something in the neighborhood of $1.2 billion of return of capital this year. So very significant number coming from a very, very healthy business. And you can see on the right-hand side that the industry has kind of moved towards about a 3% dividend yield. That's up in past cycles from about 1%. So this is a great place to get some yield, but also sleep soundly at night knowing that you have some exposure to gold and perhaps a great gold equity like Agnico.
Dave, can't thank you enough. Really appreciate it. We'll have to do a longer piece next time. Thank you very much, Dave. Dave Smith, Agnico Eagle, CFO. We'll be back very shortly with Piedmont Lithium.
All right.
Thank you. All right, welcome back to Grizzle Commodity Con. Patrick Brindle from Piedmont Lithium, thank you so much for joining us.
Yeah, happy to be here this morning.
Really appreciate it. Now, Patrick, lithium has been, the commodity. I believe the commodity of the hour. Kuppy would say oil, but I'd say lithium is your supercharged. If you're bullish oil, you sure as hell should be very bullish lithium. My 2 cents, and I'm sure you agree as well, Patrick. Now, could you help us understand the dynamics around the exceptionally strong demand for lithium? We got a good chart will pop up here, but it's I've never seen, this is really an incredibly tight market.
It is, and I think there was a real pivot in the market going back to last year, through the course of 2021 and really into the first half of this year. We saw a lot of announcements among OEMs and battery producers to commit some $25 billion in new investments in the U.S. battery manufacturing capacity by 2030. For us as a prospective lithium hydroxide producer, we're excited because nearly all of this production for the North American market is going to be in the form of high nickel cathode batteries. They require lithium hydroxide as a source for the lithium units used in production. If you translate all of that investment into resulting lithium hydroxide demand in the second half of this decade, it's some 500,000 metric tons per year of forecasted demand, whereas domestic production today is only 15,000 tons per year. And if all of the pre-producers like ourselves are successful in their aspirations, bring all of our projects online, and we all hit nameplate and we all hit quality, that's still only 150,000 tons per year of domestic production by the end of this decade. So at least
incredible
here in North America, the supply-demand gap is quite amazing.
And, I think maybe we'll bring up just wondering, obviously lithium prices have skyrocketed. High level, how sustainable is this current pricing environment? And, and the impact to, does this impact the economics of EVs? Just maybe just high level thoughts here. Obviously, this is a great point too. If we can sustain these kind of prices, that obviously would be a benefit for you as you come online. But maybe your thoughts on just the pricing right now.
Yeah, if you look at where spot pricing is in this chart versus the long-term forecast that we assume in our technical studies, which is shown in the dotted line, kind of a 1/3 of the way up on each of these figures, you have to remember that prices are very, very robust right now in the spot market, but spot sales only represent a small fraction of the lithium that's bought and sold. That said, we firmly believe that, and a lot of current producers would expect that 2023 contract pricing will be materially higher than 2022 contract pricing. And certainly we believe that the long-term forecasts through the end of this decade and in the first part of the 2030s is going to be materially higher than older long-term forecasts for a lot of reasons. Supply-demand differential, the fact that we're going into a period where cost of capital is probably going to be higher. We're going into a period of structural inflation where operating costs are going to be higher for a lot of producers, and that's going to shift where the incentive price needs to be to bring new production online. We're very bullish about lithium prices for the next decade, as I'm sure most of our friendly competitors are as well.
Wonderful. That's a great overview there. Now for Piedmont and where you guys stand, you guys have 4 unique projects. Could you just take us through that? We're going to bring up a graphic you can talk us through, all at different stages, different aspects. Maybe you could help us to talk through that.
Yeah, absolutely. So like a lot of juniors, we started our adventure in 2016 as a single asset company with our Carolina Lithium project in North Carolina. Last year, we were quite fortunate before the run-up in lithium equities to make 2 very successful strategic investments with our joint venture partners at Sayona and at Atlantic Lithium. That's kind of translated into a new strategy where we see the deployment of about $2 billion worth of capital over the next 4 to 6 years. And we would like to bring 4 projects online over a 2023, 4, 5, 6 time period, starting with the restart of the North American lithium mine in Quebec in the top bar. We own 25% of that asset. We bought it out of bankruptcy in August of last year, together with our partners at Sayona. We're actively spending money today, looking forward to a restart of spodumene concentrate production in the first half of 2023. At Atlantic Lithium, this is a Ghanaian project, Awuya, where we own 9.9% of the parent company, Atlantic Lithium, an Australian headquartered and AIM-listed business, and we have an earn-in right to 50% of the Ghanaian assets. That project is in pre-feasibility today, with pre-feasibility expected to be completed later this summer, maybe late July or early August. We'll submit a mining license application to the Ghanaian ministry towards the end of summer. We would like to see that project in operation by late 2024. Ghana and Quebec will support a lithium hydroxide plant that we brand currently LHP2. And we'll import spodumene concentrate to support 30,000 tons of lithium hydroxide production per year. We're finalizing site selection at this time. LHP2 will be located in a southeastern U.S. state. We're wrapping up negotiations among a couple of finalists. We would expect to make an announcement on our site selection at the end of this month or shortly in July. And then lastly, our largest project, Carolina Lithium, we continue to work through permitting processes. We hope to have our North Carolina state mining permit later this year. We hope to wrap up all of our permit approvals at some point next year. And then Carolina Lithium will follow the construction decision at LHP2. So we've got a very disciplined and measured capital deployment program, and we plan to bring tons on incrementally over the next 4 years.
So, Patrick, I wanted to ask you, you are a North American operator, wanted to talk about the regulatory landscape there. As you look at domestic lithium production, is that a priority for governments? Are you finding them pretty friendly on the permitting front in discussions you've had about, moving the industry forward at home?
Yeah, certainly the administration has, put forward a number of announcements over the past 6 months or so in support of battery materials development generally, whether that's DPA Title III program, whether that's kind of renewed interest in the Department of Energy's ATVM program through the Loan Program Office. That's where we've had a lot of good working relationship with the administration over the last several years. Frankly, both the Trump and the Biden administration have been quite supportive of our project at a DOE level in terms of funding opportunities, et cetera. On the regulatory front, for us, our projects in the United States, our private land developments, and so we deal with fewer federal agencies. We don't have an interaction with organizations like Bureau of Land Management, et cetera. So a push on the regulatory side is probably something that's a little bit less applicable to a company like Piedmont. But generally speaking, we see support at many levels of government.
Yeah. Patrick, we're I think this is a phenomenal first cursory look at Piedmont, and we're going to do a battery metals conference that we'd love to have you guys there. That's going to be in August. So let's flesh out the business further. Lots more to talk about. Can't thank you enough for joining Grizzle Commodity Con.
Gentlemen, happy to be here today. Would love to be back together in August. We'll have a lot of great news flow between now and then. And for your listeners, I hope they and viewers hope they would like to learn more about Piedmont Lithium.
For sure.
All right, great. So
Thank you, Patrick.
everyone, we've been through gold. We've talked about some oil. We talked about some lithium. Now we're going to silver next. We're going to talk to First Majestic Silver. Don't go anywhere.
Everyone, welcome back to Grizzle Commodity Con. First of all, if you are watching on YouTube, and there's a ton of you out there, please hit that thumbs up button. And if you are on Twitter and you're enjoying the stream, hit the retweet.
Let everyone know. Friends don't let friends not learn about commodities, and especially silver. So we have the pleasure of joining. We have Keith Neumeyer with us, CEO and founder of First Majestic Silver. Keith, thanks for being with us.
Well, it's nice meeting both of you for the first time, Scott and Tom.
Yeah, great to meet you. And Keith, for those who don't know, Keith is one of the greats on Twitter when it comes to precious metals. Man, there are a few animated voices limited on Twitter when it comes to precious metals. You're one of the greats.
Yeah. So thank you for making Twitter an exciting place for us.
Well, I enjoy doing it, and I just find that I wish more of the mining executives out there would be as vocal as I am.
Yeah. Agreed.
So Keith, maybe can we just start? Can you briefly introduce investors to First Majestic? Maybe a brief overview of your assets and your business model. We'll throw up a good visual while we're chatting about that.
Oh, sure. Okay. Well, as you said, I founded First Majestic. It was way back in 2002. So we're, approaching our 20th year in business, which is exciting. I wouldn't have expected to see or predicted the volatility of the silver price over that period of time for sure. Now, I put the company together based on my thesis that silver is a strategic metal, and it's required in virtually everything that we do as a human race going forward, electrifying the planet and electronics and so on and so forth. And my thesis bore out fairly well, I think, and it's now a much more well-known metal, but still it hasn't really performed as good as I expect it still will. I set the stage and started to acquire assets. Our first producing mine was in 2004. It was in Mexico. We then acquired another few mines. We now have 3 operating mines in Mexico. And just last year, we bought our first mine in Nevada. So we're happy to be in the state of Nevada. So we've got 4 operating mines. We've got 6,500 employees spread over 5 countries. Our revenue last year was somewhere around $530 million. We produced, this year we'll produce around 35 million silver equivalent ounces of silver, of which 50% of that is gold and 50% of that is silver.
Great. So maybe let's start at a high level with silver. We talked with Agnico about gold. Let's talk with you about silver. We have a good chart on the silver gold ratio over time. Can you just talk us through what that tells investors? What does it tell you about the price of silver versus gold today and in the past?
Well, it's backward looking for one. So, but what it tells me is that there's a ton of manipulation going on. Right. Quite honestly, because the mining ratio is on one of our slides. I'm not sure if you're going to show that one, but we show specifically on one of our slides on our PowerPoint that the mining ratio is 7-1. So for every 1 ounce of gold being mined worldwide, only 7 ounces of silver are being mined. So in theory, if the mining ratio equaled the trading ratio, which I think it should,
Yep.
and I can't explain why it doesn't. Well, we can try if you wish to go down that rabbit hole, but that according to this slide, it's silver's trading at 85 to 1, so it's pretty crazy, and I just don't think that could last. When silver went up to $50 back in April of 2011, the ratio dropped to 31.
Right. And has that been pretty, that 7 to 1, has that been pretty standard through the history of time? Like, or is that like something has that traditionally, that's the ratio that you typically see of pulling gold and silver out of the ground?
Yeah, it's a great question. And the answer is it's declining.
Okay.
When I put the company together almost 20 years ago, the ratio was 12 to 1. The scientists feel that there's approximately 15 or 16 to 1 silver to gold in the Earth's crust. But during my career, we've never mined at that ratio. It's always been below that ratio.
And it's fair to say that on the silver side, in terms of the applicable industrial uses, like that's, when you think about store of wealth, that's obviously something where relative to gold, silver has an advantage there in terms of demand on the demand side.
Well, for sure. There's more gold on the Earth's surface than there ever has been in the human race. We're mining 1 or 2% additional gold per year. That gold gets put away into vaults. Federal governments, banks, central banks, jewelry, and so on. Very little bit of gold actually gets used in industry. So most of that gold is just put away in storage, and it just accumulates. Silver is quite different, where you've got about 90% of the silver being mined today actually gets put into waste dumps and gets lost because it's not economic to recycle. When was the last time you recycled a television or a computer or a cell phone? It's very rare that people do that, and the companies that have tried to do that actually have gone bankrupt. There's very few successful recycling companies out there. There's a few in Asia, but they just burn it, and it creates quite a lot of pollution by doing it. So doing it economically and in a feasible fashion, environmental fashion, it's almost impossible to recycle the metal out of a cell phone.
Now we're talking about demand a little bit. Maybe you could take us through. I'm curious on the renewable side. It looks like that's a big demand growth driver here. Now, would you say, is that the single biggest demand accelerator for silver, or is it demand growth coming from other places as well?
Yeah, when I put the company together, the production, I have to go back and look at the chart. We do have a chart on our website, but I think the production was somewhere around 650 million ounces of silver. And consumption was somewhere around 800 million ounces. So we were still in a deficit back 20 years ago, and that deficit's pretty well been there ever since. During that time, all the above ground supply, or maybe not all of it, but a good majority of the above ground supply has been gobbled up by industry, and today, silver demand is around 1.1 billion ounces this year, 2022. I've heard numbers suggesting higher, but we'll see how it all evolves. The miners will produce about 850 million ounces of silver this year. Silver peaked out in 2015 at just shy of 900 million ounces. So it's been kind of dropping a little bit every year. The miners actually produced only 730 million ounces in 2020, which was the COVID year. 2021, it picked up again. In 2022, it's expected to be around 850 million, as I said. So we're likely going to have a 250 million to upwards to possibly 300 or 350 million ounce deficit this year. And just going further along this path a little bit to answer your question about new industries in the ESG area, which is really the two big drivers, which is electric cars and solar panels. These two industries didn't exist, 20 years ago when I formed First Majestic, and I thought then that the supply demand fundamentals of silver were pretty dynamic. And now we've got two industries consuming about 25% of the world's supply of silver. So it's pretty nutty.
It's that high, 25% between those two. Incredible.
It is. Yeah, and well, look at the electric cars for a second. Now, it's really hard to get this data. The Silver Institute, works very difficult, a lot of time, and they hire consultants to try to, contact some of these big consumers. But the big consumers don't want to tell you. BMW doesn't want to tell you how much copper they use or how much silver they use because they're paranoid about being front run by the big institutions, the big hedge funds out there. So they keep this information very, very tightly to their chest. But we estimate that in a regular, like call it a Tesla, it doesn't have to be a Tesla, but just for argument's sake, there's approximately 1 kilo of silver in that car. And that silver is used for the high speed connections between all the computer components and the batteries themselves, because it's very high speed communication, and there's really nothing that can do that other than silver. And then you look at the total amount of electric cars produced, and we don't have the 22 numbers, of course, but 2021, we estimate that there's somewhere around 8 million electric cars produced globally, of which 65 million ounces of silver were consumed in that one market alone. So that's over, or just shy of, 10% of the world supply going to just automobiles. Now, with industry or with governments pushing the fuel combustion car off the road and wanting to replace it with electric cars, we're going to have to produce a lot more than 8 or 9 million cars a year. There's 1.4 billion fuel combustion cars sitting on the surface of the earth. The auto industry produces about 90 million cars per year, of which about 10% of those are electric cars. That number is going to have to go up to 30, 40, 50%. And if you just do the math yourself, if for every approximately 8 million cars consume 65 million ounces of silver, and you want to produce 30 or 40, 50 million cars, that's a lot of silver. If you look at the solar industry, this year we're expected to see 140 million ounces of silver being consumed in the solar panel industry. And you're seeing the news coming out of Europe about trying to get off Russian oil and gas and building big, huge solar farms. And you're seeing these types of announcements coming out worldwide. And, who knows what the silver demand is going to be, but it's been growing dramatically. And at 140 million ounces for that one industry, it's, that's my point. You got two industries growing like crazy, needing a ton more silver.
Yeah, and a big part of the market demand-wise.
And just questions here on YouTube. One from Paul Rath. What he's saying is that we're talking 150 million ounce permanent decade-long supply deficit. Where does Keith think the gap has been? Will be supplied from? Is it what's going to make up for this gap?
Well, some of it does come out of recycling. Recycling is at lows because of the price. We saw that big spike in silver prices back in 2011 when recycling hit 250 million ounces that year, which is a pretty significant number. But at $50 silver, a lot of the old silverware that's sitting in people's homes and, old jewelry that people weren't wearing anymore, all got handed in. You saw those little stores, start popping up in every single mall, throughout the world, trying to buy any kind of scrap gold or silver they can get their hands on. And those stores are all gone now. And because really there's no more supply out there of that type of metal. So, who knows what price you'd have to see in order to influence people to start handing in old silver and gold again. I have no idea, but it's likely not going to be $50 an ounce.
That's a fascinating point because obviously the last cycle you saw so much of that, and that's been completely void this time. That's probably one of the greatest tidbits I've heard about how just the dynamics of the market right now. The fact that we're not seeing that bring in your junk, like it's just they're not on the radio, they're not you would be inundated right now.
Yeah, for sure. And, I think you need triple digit silver for that to happen again and to incentivize people to hand in their old jewelry and so on. And so today we estimate that recycling is about 125 million ounces. So, if in a deficit of 300 million, approximately call it 40, maybe 50%, give it if you want to give it that much credit, comes back into the market through recycling. And that other half, is a bit of a mystery. Governments don't report silver, so we don't know really what governments own. We do suspect that Russia and China own substantial amounts of silver. What they do with it, we think they use it for their own industrial purposes, but we don't know. But definitely, the silver's come from somewhere. It's filling the market, but the market's growing quite substantially. And my thesis is one day that manufacturers just simply not going to be able to produce a product, an automobile. You're seeing that the chip shortage is affecting worldwide supplies of electronics and automobiles and so on. We could see similar headlines about silver and other metals.
Gotcha. Well, Keith, it's been a pleasure talking with you. I think we kind of just scratched the surface on what you built at First Majestic, but we'll be watching you closely in the years to come. So,
and Keith, we'd love to have you join our gold and silver conference in September. It's important to have First Majestic there.
Sure. Well, this is a new relationship. I'm happy to start it, and just keep us up to date on what you're doing. And I'd be happy to spend some time talking more about the company. We barely touched there's so many other things we could have talked about. So
exactly,
we could go for a long time. You know what? We'll have to do a half-hour slot next time. A nice quality overview of the silver market, First Majestic. Thank you.
Sure, that'd be great. Look forward to it.
Thanks, Keith.
All right, everyone, don't go anywhere. Next, we're going to have a company doing some really interesting things in the green metals space, specifically vanadium, which you may not know as well as gold or silver. So don't go anywhere.
Welcome back to Grizzle Commodity Con. It's been incredible. We've had an incredible stretch through the morning. We've been nonstop.
We've been flying through the commodities market. We've been going to every corner of the commodities market. We got a new corner right now.
Oh no, it's very exciting, vanadium. For those, before we start, if you guys are enjoying what we're doing, please do two things: hit the like, hit the subscribe. If you're on Twitter, hit the retweet. Really appreciate it. We got a great company right now. Alberto, how are you from Largo?
Very good, very good. Happy to be here. Thank you for the invitation.
Thank you very much.
So, Alberto, you guys are one of the most ambitious, I think, in commodities and what you're trying to build. You're not waiting for certain markets to develop and come to you. You're building them yourself. So maybe to start off, for people new to Largo, could you briefly explain the company's business model? Because you have three pillars, and the unique strategies you're pursuing in batteries and physical vanadium. And maybe we'll throw up a chart while you're talking to that.
Yeah, perfect. Largo has we like to present ourselves as a two-pillar strategy. Basically we have the mining business where we produce vanadium, and we are a tier one producer of vanadium. And the second pillar is the battery business that we're developing in the United States that is related to the vanadium market. Something that is very innovative is the creation of a physical vanadium company, like an ETF called Largo Physical Vanadium, which plays a very important role to reduce the cost of these batteries, make them more cost competitive, and also improve the market fundamentals for vanadium. But just to tell you a little bit about our business in the mining business, we produce around 7% of the world supply of vanadium. We're the largest primary producer. We have the lowest cost, or one of the lowest costs in the industry, because of the high quality of mine that we have in Brazil, with the highest grades in an ore body, and a great technical team that helped us put it off the ground a few years ago. So we're very excited of being innovative in the vanadium space, and being a player in the vanadium supply and in the battery business.
That's great. Now, for me, it's been super interesting what you're doing with your battery business. You're essentially cultivating demand for vanadium instead of waiting for the market to develop. Can you briefly explain the benefits of your V-Charge batteries for large energy storage products, compared to a lithium-ion battery that we have in our cell phones, for example? The carbon footprint, reliability, et cetera.
Yeah, exactly. It makes a lot of sense for us to get into the battery business because of our significant position in vanadium, right? So when you look at our customers as a vanadium producer, we thought there was a great opportunity of participating in the growth that we see in this green revolution in the batteries. And there is this technology, vanadium redox flow battery, that has a great potential to solve some of the critical problems of this green revolution. Some of the advantages relative to lithium, for instance, is that it's safer. The energy is stored in liquid form in an electrolyte that contains vanadium. So that's a very important factor. Another one is that this electrolyte that contains vanadium is fully recyclable.
That's huge. That's a huge difference.
Yeah, and what we did with this unique characteristic, we believe that we could use this electrolyte, the vanadium in the electrolyte, as a storehouse of value, and create an ETF that would actually become a publicly traded instrument in which investors could be buying and selling this, similar to what Sprott did in the uranium market a year ago, but even better, because instead of having the units of metal being stored in warehouses, what we want to do is store some of this metal in the batteries themselves. So they are making something very useful for society. They are working for you, and they are enabling the battery customers to have lower costs and make it more competitive on their business model.
From an investor's point of view, so if we're buying that vehicle, we get access to holding vanadium and the price appreciation that could happen. Is there also an income component with that you still are owning the vanadium that's going in the batteries? Could you help us understand that a bit more?
Yeah, obviously, this is going to be a publicly traded instrument. It's subject to regulatory approval. The money has already been raised, around $30 million. So we are on our way to make it a reality. But answering your question in terms of, is there a yield? No, investors are going to be participating in the appreciation or the depreciation of the vanadium price, similar to other ETFs. Like, one of the unique characteristics here is that as you put this vanadium into the batteries, there is a very small fee that is going to be paid by the customers, and that fee is more to offset some of the administrative costs that happen in ETFs like this. So it's very efficient from an investor perspective that there is not attrition of value. Those administrative costs are going to cover by the de minimis fee from customers.
Yeah, this is going to be unique because it's been hard to get access to the vanadium market in the past. So this should make things easier for investors. Okay.
Well, the great proxy is what happened with the uranium market. I think a lot of investors, saw that precedent. I believe that there is some similarities here, and if we are able to achieve something like that, we're really benefiting the two pillars of Largo, right? In our mining business, we are improving the supply-demand fundamentals more on our business because this ETF is going to be buying physical vanadium in the spot market. So that should be something good. But on the battery side, it's something that has never been done before. And I want to emphasize this because these vanadium flow batteries, it's a technology that's been around for a long time. But the biggest problem was, how do these companies and customers get the vanadium at an affordable price and without volatility? Yeah. And we believe that we have solved this problem with this ETF. Now, the battery customers shouldn't worry at all about the price of vanadium or the volatility of vanadium. And this is the first time this happens. So we're very happy at Largo to be the innovators in this industry.
Yeah, Alberto, this is really like when you think about in terms of things that can accelerate technologies and accelerate adoption, you guys have really come up with a structure here that really does that with this, right? It's something pretty remarkable.
Thank you very much. We're very happy to lead in the industry. I worked on Wall Street for a long time. I used to follow metals companies, and I admire companies like Alcoa, for instance. Alcoa was very innovative and trying to think about their customers and solve their customer problems with the unique characteristics of aluminum. We're doing that in the vanadium industry. Somebody had to do it, and we're doing it. And we're using that unique characteristics of vanadium to solve the battery problem. And we're very excited about the future and the results of that.
Now, Alberto, I was looking through your deck, and there was a slide that kind of jumped out at me. It looked like you're forecasting some significant growth in free cash flow, in the near term and the long term. I'm just wondering, could you take us through what's driving the significant growth? Maybe we can throw up that slide too at the same time.
Yeah, that is it's a very interesting chart because it is the result of a technical report that we published last year, in November of last year. And it shows the growth of the cash flows of our mining business. And what is remarkable here is that the net present value of that mining business that we have, that first column, in an after-tax base, the net present value is $2 billion, which is approximately 4 times our market cap, which is, remarkable. And, we are not assuming any value yet on the benefits of the Largo clean energy business or any benefit from improving fundamentals of the supply demand by Largo physical vanadium. So I think it's really great to quantify it like that. What is bringing this growth is that we have, besides vanadium, our ore body also contains titanium, another metal, and we are starting to implement the process of doing titanium as a byproduct of what we are producing today. So the same rock that we extract out of the mine has vanadium and titanium. Now we're going to recover some credits from titanium, and eventually we're going to produce pigment as well. And the cash flows should increase from around $200 million per year once the first phase of our titanium business is there to around $400 million per year, which is remarkable growth out of our mining business alone.
Now, I wanted to go back to the V-Charge battery business. Is there anything that's keeping you from scaling at this point? Like, do you have to do any more testing or production cost scaling? Or say if the customers really, this resonated with them and they were coming out of the woodwork and they said, this is the battery technology for me, can you scale that up to meet it now?
Well, we are building our manufacturing facilities in Wilmington, Massachusetts for 1.4 gigawatts per year. So that's a pretty ambitious plan. I was visiting the facilities just a couple of weeks ago, and we're very happy with the progress. In terms of what is limiting, we thought at some point that the limits would be the amount of vanadium that our mine can produce. But with the creation of this ETF instrument, the Largo physical vanadium, we've given it the flexibility of being able to buy not only the vanadium from our mine, but vanadium from other sources as well. So that would unlock some of that restrictions of growth that we perceived before. So we're really positioning Largo to participate in a significant growth of this battery business. And we're very excited about what we see in announcements in Europe and the United States in terms of mega infrastructure commitments on the green energy revolution.
Like when I think about it, where this sits in terms of this is utility grade, like this is really where the crux of the crisis is happening right now. This is the Europe's 5-alarm blaze, if you will. And this would address that, right?
Exactly. And we feel that at Largo, we are at the right place at the right time. And we really want to be positioned to participate and get the opportunity. There is a lot of competition of different technologies, and we believe that vanadium redox flow battery versus other flow batteries is the one that is the best. The only problem was vanadium, and we've solved that problem for the first time. Against lithium, there is, depending on which is the period of discharge rate, there are some segments that is better for lithium than for vanadium flow batteries, but we think that between 5 to 12 hours of discharge period, it is ideal for the competitiveness of our business, and that's ideal for renewable power, and that's exactly what the world needs.
Well, I mean, the commodity market sometimes feels kind of the same year after year. And so it's been really refreshing talking to you and what you're trying to do in the vanadium side of things. So maybe just to wrap things up for everyone, put it all together, what are the most important catalysts investors should be watching from Largo in the next, say, like 12 months?
Well, I think what we are doing at Largo Physical Vanadium is very critical. Obviously, subject to regulatory approval, but once we get it, I think that is a catalyst because you are going to see, Largo Physical Vanadium buying vanadium in the spot market. That's one thing. The second one is on the battery business. These announcements that we're seeing, we want to participate in them, so we are really positioning ourselves to be able to grab some of those opportunities. The third one is this titanium co-product or byproduct that it's something that we're building right now. So by early next year, we should be almost completed our first phase. And I think it's going to be a validation that those charts that we have presented in terms of the growth of cash flows are coming into reality. And one final thing, the leverage that Largo has on the vanadium price. Some of your charts that you put in there show that sometimes the price of vanadium spikes. Last time it happened, it was in 2018. Vanadium price went from 7 to 30. And sometimes that happens because of supply shortages. It showed historically how leveraged Largo is on the vanadium price because we generated around $400 million of cash flows, Canadian dollars, which allowed us to pay all of our debt, and we've been net debt free since then. So I think it's a very exciting situation. At Largo, we're not betting on one horse, we're betting on 3 horses.
Alberto, thank you so much. And we would love to have Largo join us for our Battery Metals Day in August. We need to hear more about the Redox Flow battery.
Yeah.
We're going to flush out. I'm very excited for that day. That's coming in August. Would love to have you guys there and join us.
We definitely will be there. We'll be happy to tell our story. Thank you very much.
All right, this is Alberto Arias, non-executive chairman of Largo Inc. All right.
Welcome back, Grizzle Commodity Con. As only a commodity conference can be, we are very fortunate to have Crescent Point Energy join us. The one oil and gas producer. Very, very excited to have you guys here. Thank you so much.
This is my bread and butter. I'm excited to talk oil and gas.
Thanks so much. Thanks for having us.
Yeah, excited
All
to
right,
be here.
so can you walk investors through how Crescent Point thinks about prioritizing organic growth and M&A versus dividends and buybacks? This is the kind of the question I'm sure you get the most from investors right now. So love to see your thought process as you're generating significant, cash flow and free cash flow.
Yeah, no, maybe I can take that one. So appreciate it. And thanks again for having the opportunity for us to speak here and present here. So we actually have a pretty good slide in our presentation deck that walks through our capital allocation framework and how we think about things when it comes to budgeting. Basically, for us, everything starts at the asset level. We look at unit level economics. We think about long-term project. We think about environmental initiatives. And that basically forms our maintenance budget for us. So as you can imagine, you generate a bunch of free cash in the business after that. And then the first things for us we prioritize is the balance sheet and the base dividend, obviously with a bit of a preference on the balance sheet, making sure that's in check. Then after that, then we assess follow-on things, and it's all based on competitive returns. We'll take into account maybe additional return of capital, reinvestment in the business, M&A, and so forth. So when you take a step back for us, really the overall model is we want to provide a meaningful amount of capital back to shareholders, starting with a base dividend and maybe other forms of returning capital. Right now it's buybacks. And then try and create value in the business on a per share basis, debt adjusted, whether that's organic or inorganic opportunities. And like everything, I think you need to have governors around your business model. You need to have governors around your debt levels. You need to have governors around your dividend payout ratio to make sure that's sustainable and can grow with the business. You need to have governors around growth rates. For us, we think about disciplined growth in that 3 to 5%. You need to have governors around your buyback framework to making sure that you're buying at intrinsic value, below your intrinsic value, and it's accretive, as well as your M&A criteria. At the end of the day, it needs to enhance the business. And for us, the two key pillars are, does it enhance us around balance sheet strength and the sustainability of the business? So we have governors around each of those things. We won't get into specifically every minutia and things that we look at. But when you take a step back in the current environment for us, we're probably at strip prices about $1.5 billion of free cash, excess cash flow that we'd be generating in the current environment here in 2022. So lots of money to achieve various points and parts of that overall value proposition for us. But it starts with a balance sheet and base dividend, and then we layer on additional items through that. And like I said, a big part of that is return of capital, and then the other part is reinvestment in the business.
Gotcha. So maybe drill in on the debt a little bit. Where are you now? And do you have a certain absolute debt level target, or is it a ratio of EBITDA or some earnings number?
A bit of both. So what we put out in the market is a near-term debt target of 1.3 billion, which equates to 1 times debt to cash flow at a $55 WTI level. I think we'd like to get it lower than that longer term, but that's a starting point. We've been active here with free cash and being disciplined and prioritizing the balance sheet. And then we've been also active on some non-core dispositions. So, we're well on track to get to that target here in early Q3. And then look for some more color around, our thoughts on capital allocation going forward. We've been pretty clear with the market that as we've been getting closer to that, we've been increasing our return of capital back to shareholders through dividend increases and buybacks. So we're well on track to continue that momentum and continue to balance that shift a little bit more towards more return to capital. But that's a starting point. And I think, debt has been an issue that has ruined a lot of companies in this industry in the past. And we just don't want to hear about debt, going forward at all. Can't hear you guys.
Yeah.
There you go.
Yeah. Okay. Great.
Go ahead, Tom.
Sorry. Yeah. So, David, just talking about the risks, talking debt, and on the ESG side, maybe you could just talk to us a little bit about how we think about that in terms of how Crescent Point has conceptualized ESG risk and how obviously different vectors of risks across the board, but clearly how Alberta itself, how how Canadian oil is really presenting itself, and further to that, how Crescent Point is addressing that.
Yeah, sure. Happy to. Yeah. And we think, Canadian oil and gas production is among the best in the world in terms of ESG standards and the values that we embed in our operations. For Crescent Point in particular, how we approach ESG, we really look at what's material to us as a company and to our stakeholders. And so that drives and prioritizes all of our initiatives. So things like GHG emissions, water use, safety, of course, those really form kind of the basis of what we focus on the most. And then how we address those through setting ambitious targets, performance initiatives, and other things to really tackle those and make sure that we're meeting and exceeding the expectations of our stakeholders, and then also mitigating any potential risk to the business and capitalizing on opportunities going forward.
Gotcha.
Thank you.
Now, I wanted to talk about your guys' hedges quickly, because I know that investors love to talk about that on Twitter all the time. Maybe we could throw up slide number 2, which has more information on that. So how do you think about your hedges? It looks like you're at 50% of production now, but that goes to only 10% a year from now. So what's really the right level for Crescent Point?
Yeah, good question. So if you take a step back in early 2021, that's when we announced the transaction where we acquired those Kaybob assets from Shell. It was about a $900 million deal. As part of that, we basically funded $700 million or close to $700 million of that through debt. So at that time, we obviously wanted to protect the balance sheet, and we hedged forward. Now, hindsight's 2020. The commodity prices obviously rallied since then. So you have some hedging losses, but you actually have a significant win on that transaction where, we're generating $550 million of asset level free cash flow at $100 oil for a $900 million deal. So, I think where the balance sheet is now and we're getting to, and we're getting below our near-term debt target, I don't think we need to be at that 50% level going forward. Probably something in that 20 to 30% seems reasonable. The reason where you're seeing it sort of a little bit less going forward really comes down to the backwardation in the market as we go further out. So we're just basically taking a 12-month forward view right now, chipping away at it systematically, basically actively using more collars just to have some participation in the upside. But we do a mix of things that we'll look at, whether it's swaps, three-ways, collars, puts, etc. But probably going forward, post our debt target, I'd say in that 20 to 30 is probably a reasonable level. We are hedgers. We'll have some hedging, especially if we're going to have a more formal return of capital framework out there through dividends and other things. So we want to protect that in the capital program, but I don't think we need to be at the 50% that we were in the past.
That's really helpful, actually. Just I wanted to dig in a bit on the dividend. You already gave us a great how you think of allocating capital. When you think of hiking the dividend versus a one-time dividend, what's your priority? Because I know one time gives you a lot of flexibility, but the other one shows, commitment to investors. Like, how do you think about both options?
Yeah, good question. So we believe in a dividend model for sure. In the past, in this sector has been part of the sort of income trust era. We don't believe per se in the high yield model in the past. We want something that's sustainable, gives us flexibility to run the business, potentially choose to use levers. Maybe there's a bit more creative and something around a buyback, but have a sustainable base dividend that can also grow with the business, not something that's high that we have to grow into per se. Then we would look to supplement returns on top of that. Right now, the preference is buybacks, but if at a point a buyback doesn't make sense, that's where you could see perhaps something else. Maybe it's a special that is one, supplementary in nature and additive to that to give that extra yield. So, we believe in the base dividend model, and supplementary to that is the thought. It's a bit of a combination of various tools in the toolkit, if you want to say it that way.
So it sounds like base dividend, buybacks, special, or some other option is how you're judging it at the moment.
Correct.
Got it.
Yeah.
Okay, moving back maybe to ESG a little bit, because that is an important focus for you guys. Could you talk us through your highest priority ESG initiatives over the medium term and why? And maybe also, I saw you had a good chart that you're cutting emission intensity a lot by 2025. What are the main ways that you think you're going to get there?
Sure. Yeah. So certainly within our priorities, GHG reductions has been a core focus for us. Since 2017, we've reduced our GHG emissions intensity by 50%. And within that, the achievement of that target also included a 70% reduction in methane. So that's really looking at our operations, looking at how can we avoid emissions from the outset. So in our development planning, how do we set ourselves up for success from the outset? And then also for wells and infrastructure that's existing and on the ground, how can we tie in volumes, commercialize that gas that's associated with our oil production, but perhaps more of a byproduct and not our core focus. And certainly in this market today, we're really realizing some good returns on that commercialized gas. And then for those sites that don't lend themselves to, the economics just aren't there to tie them in, looking at how do we, destroy that methane through combustors or flares or other kind of utilization projects to make use of it. We've also done a number of projects on fugitive emission sites. So looking at, using aerial surveys and other detection methods to really find leaks and repair those to avoid any potential emissions in that regard. In our next sustainability report, we're happy to announce some new targets. So stay tuned for that and continue our journey across all these kind of priority areas.
Well, Shant and David, we really appreciate you taking the time to tell us more about Crescent Point. We're sorry. So we're sorry that you're in the office, but from an investor's point of view, it looks like you're working hard for us. So thank you very much for that.
Of course.
Guys, thank you so much. And we would love to have you guys join our oil and gas day in September. It's going to be a big one, and we'd love to have Crescent Point.
Yeah, we'd love to hear more about Crescent Point.
Awesome. Yeah, we're open to the opportunity. So thanks again for having us, and look forward to the relationship going forward.
All right, so that was Shant Madian, VP of Capital Markets, and David Gowland, Director of ESG at Crescent Point Energy. Now, don't be going anywhere. We're heading back with some very exciting guests, and we're going back to the land of gold. Yep. We have white gold next.
Grizzle Commodity Con. The show continues. We got white gold right now. But before we kick in, please, if you're enjoying the stream, hit that thumbs up, the subscribe. Let the fam know. Grizzle Commodity Con does not stop. It's going for like 8 hours. It's a nonstop.
Yeah,
train.
where are you hearing from this many leaders in this many different commodities all in one day?
No, it's incredible. We have the pleasure of having the CEO of White Gold, Dave D'Onofrio. Thank you so much for joining Grizzle Commodity Con. I really appreciate it.
Yeah, great to be here. Good timing, obviously, with the PDAC conference in town. People are pumped on commodities. This whole June format, we had 2 years off with, the COVID restrictions, but I think it's typically in March, as you guys know, but doing it in June, I think a lot of people liked it. It made the social aspect, which is a big draw, that much better.
Dave, you know what? For the first time, because obviously the town has been pumping. So those who
people are pumped on life, not just commodities, I think.
So, it's a very special week, obviously, Grizzle Commodity Con, but this is on the tail end of the PDAC, which is the largest mining conference in the world. And Dave and I are native Torontonians, and Scott was a Torontonian for 5 years when he was here before he moved back to Philly. But this, I have to say, moving PDAC over has been incredible. This town was pumping. It was incredible.
Yeah. No,
Mining's back, baby.
It's a great event. And this year was special, right? Nobody wanted to be shut out of seeing all their colleagues for 2 years like they have been, and so obviously important for the industry, but I think just important people get to see each other again. And the world's gone virtual, but I think you can never replace face-to-face contact, and life's a combat sport, and this is where things get done. It's amazing, no matter what people say. It's where things get done. It's the guy you bump into randomly, running from one meeting to another. Hey, let's catch up, and deals come out of that kind of stuff. It's remarkable, but that's the reality of the world.
Mm-hmm. It really is. And, Dave, thank you so much. And first I'll kick it off. Could you give us a history of White Gold and what drew the company to the White Gold district in the Yukon? We got a visual we can throw up as well, just kind of like a history. But like there's some very high profile investors involved here.
Yeah, White Gold's a pretty special company. Just to give people a little bit of context, so I'm with the Power One Capital Group. We're a boutique merchant bank based in Toronto. We've been sort of very focused on mining, exploration, and development, investment, and finance for about 20 years now. It's a special area of the sector. Some of your other great guests are, participants, and they're probably a little bit more senior in the sector. This, where we've focused, and been fortunate to have, a lot of success, is in these very early days of exploration, right? And that, this is kind of a speculator's dream, where you have an idea and a thesis, and you raise a little bit of money, you stake some claims, and see what you might be able to find. And there's a lot of guys that titans of the industry. That's how they started, by having success early on. And the reality is, this is it's the most challenging part of the industry, but it can certainly be the most rewarding. So what drew us to the White Gold districts? So the guy who's our partner in this deal is named by Sean Ryan. So this is his brainchild. And what drew him to this area, which is in Canada's Yukon, right, the northwest corner of Canada. And this is the site, the epicenter of the Klondike Gold Rush, right? It's 125 years ago. You guys, you see it all in the history books. 100,000 prospectors from all over the world. Here, there's gold in the creeks in Canada, in this crazy part of Canada, and they basically risk their whole entire lives, right? And like, let's go. They don't know what's there. You don't have a phone, and you get there, and and you realize like, we can't move with horses. We got to figure this out with dogs. You got the Shilku Pass, and like, sadly, it was hard. Like, a lot of people, made a lot of money. Like, some of Canada's biggest banks were started, from the mining that they did back then. The history is actually incredible. It's a very romantic story, but like most of these gold rushes, it was tough. And after a few years, a lot of people didn't make it, and then they sort of left. But what did happen since then? What happened was 20 million ounces of gold were found in the creeks, like at surface in this district. Wow. And even today, there's people are still there, still finding gold. You see this, the Gold Rush show on I think it's Discovery Network or whatever. It's like,
that's right.
People go now. Sean Ryan, our partner, he's a notorious prospector. He's won the the PDAC Prospector of the Year award a couple times, New York Times Magazine cover 2 times. He's he's from Timmins. He's a mining guy. He's like, I don't get it. There's 20 million ounces of gold 100 years ago. Why has nobody gone to perform proper modern day exploration? Right, drill this thing, and that was our question too. So he went there, right? Like, he's leaves his life behind. He goes there. He's a mushroom picker. It's an amazing story. He's picking mushrooms, looking for gold. And what he found out, yeah, I'll send you guys the article. And he's got some. He's a very unique and special
Well,
guy.
he's a character. I saw a great video, and he had this one line, and we're going to talk about it later. The more targets, the more frogs you kiss, the more princesses you'll find in the end. That was in a video, and I'm like, this guy's a poet. He's a mushroom picker, and he's a prolific gold discoverer.
And that's the real reality, and what makes white gold so special, or part of it. And I'll get to that. It's just like the size of the opportunity. So he gets there, and then he quickly figured out when he gets there, he's like, oh, I see why no one's come here to do any prospecting. And the reason is that area of Canada was not glaciated, believe it or not. Like the glacier kind of missed it. So most areas, Quebec, Ontario, where you're doing this early stage reconnaissance prospecting, you see the outcrop. And that's where you got the guys with their little ball peen hammers, the geos, they wear that clip. They see the surface of the rock. They take their few chip samples. They bring that to the lab. The lab says there's gold, no gold, nickel, zinc, whatever it is. Mm-hmm. But there's no outcrop. So the tool that people use in this neck of the continent just doesn't work. So guys don't go there. So Sean's like, I'm not going to let that stop me. So I got to figure out a different way. And what he honed into was a technique. It's used other places, not as common, where he was able to analyze the soil geochemistry and use that as his indicator of where there could be mineralization. And it's not just like you find gold in the soil, maybe there's gold below. It's all these other pathfinder elements, bismuth, tellurium, arsenic, whatever. And he's a research analyst, like not formally trained, not PhD in geology. He's doing all the work on his own dime. And he's a studier, and he's doing all the research, and he finds these correlations. And through that, he said, okay, I've identified these systems. I see like the layout of the land. These look like the areas that could host these intrusion-related gold deposits, whatever it is. He goes, he stakes it up. He, comes to like the big city with his, his ideas, and gets a few people to invest in back and partner with him to start doing some drilling, like proper test. And this is kind of 2009, 2010. Well, don't you know, lo and behold, within 2 or 3 years, they tap into 2 like major, like multi-million ounce world-class gold discoveries, right? Like it's unheard of to have that kind of success. The first one was at a company called Underworld Resources. They discovered was the Golden Saddle deposit. It's actually part of White Gold now. I'll get to that. Kinross comes in, buys them out for like $140 million. Over the ridge, he's got another property. They tap into what's now the Coffee deposit. That was with a company called Kaminak Resources. They make the discovery. They drilled it a little bit further, got it to be bigger. Goldcorp comes in 2016 and buys them for $520 million. Like it's like the ultimate dream of a project. And it does never happen that fast. Usually you got to go through a couple cycles. There's other issues. And it created an insane staking rush at that point in time, right? You hear, so the whole, 125 years ago, the whole world moved there. It's just now it's not guys with pens and, rubber boots. It's real exploration companies, right? Yeah. And they saw the opportunity. Now, there was a pro and a con to that. The good thing was Sean was able to option off the other claims he made and do a bunch of work. What happened was, though, that was 2012, 13, 14. The junior resource market got really soft. Commodities were depressed. So a lot of these companies weren't able to maintain their obligations to Sean in order to keep the properties and earn the properties in a buyout. A lot of these deals are done that way, right? So Sean got his entire package back. There's like 1 million acres of land that, and were $25 million of other people's money got spent on it. And so he's sitting there, like, I can't believe this. Like, I have a theory. It's successful. I just had these 2 great, acquisitions by majors. And now I own the rest of the district with all this work. I see the data. I know what led to those discoveries. And like what I have here is as good or better. So it was incredible. This is, and this is what leads into, making this company so successful. So where do you want to look for gold? You want to look for gold where there's gold. You want to look for gold where, it's safe to look for gold. And you want to look for gold where there's an opportunity to sort of, have a significant stake in that jurisdiction. And this had all of that. So he came to see us at Power One. We'd known Sean for a long time. We backed him on some of his other ventures. Some went well, some didn't go so well. But, he knows, like Power One what are we? We look to be people's strategic financial partner, right?
Right.
There's money, but there's more than money involved. There's our relationships with the other financial institutions on the street. We work very closely with them. And part of having a successful public company, especially the junior stage, is you need to have a proper audience, right? In Canada, it's not hard to take a company public, for better or worse, but it's hard to have a company go public well. And what I mean by that, to have the proper audience down the road, so when you are successful, you have access to additional capital, you have institutional research, you have sales and trading, you have marketing, and over the years we've been able to develop those relationships. I think we have a great reputation. We're long term. We do what we say. We've never screwed anybody. And now we're seeing people coming back to us with these like incredible opportunities, right? Another conversation the other day, a lot of these other companies we back, Lithium Americas, Continental Gold.
Like you were going through your list, and it's an incredible set of companies that have been bedrock companies in their respective industries.
Yeah, and what's great now is like now that these management teams have had their success, they say they're going to retire, they get bored in 6 months, they go and find a new project, and These guys are winners. And now they're coming back to us, say, guys, do you want to partner with us again? And usually it's like, let's do this, absolutely. So that's what happened with Sean. So Sean comes with the stories that, guys, I've tied up 1 million acres in like what's arguably one of the most prospective and underexplored areas in Canada, in the Yukon, which is like a Fraser Institute top 10 annually ranked mining jurisdiction globally. He's like, do you want to partner with us? And we're like, this is not true. He's like, no, it's true. Like, this is the story that I just went through with you guys, and we're like, oh my God. Like, yes, we're in. Like, but like, Sean, this is such a special opportunity. Like, you're gonna, there's gonna be interest from the majors. And majors, you don't like to take too much risk. They usually don't come in too early. But we're like, the opportunity to own this much land in this area in Canada is like, I don't want to say once in a lifetime, but it's kind of getting up there. So we went to go speak, and then when I was saying our strategic, relationships in the mining business, a lot of them, we have a great relationship with the majors, right? I know you guys had Agnico on the phone today, or on the call, maybe one of Canada's best companies, if not in the world. And so we said, let's go talk to a few of these guys. I think they're going to trip over each other to be a partner this early, which they would not usually do. And literally, like, we went to go meet 4 companies that same like week that Sean was here, and all of them say, how much money do you want? Like, what do you need? And we're like, this, like, it doesn't usually happen that way, but it did. And so from that group, we picked Agnico to be our partner, and that's why
we love that. I was just saying, as you were giving, you were nailing off all the key characteristics. I'm like, this is an Agnico fit. Like, this is classic DNA of Agnico, right? And that is like, when you think about a junior, like, this is where you want to be. You want to be owning stuff that the best, highest quality major would want to pick off.
That, as a marketing thing, and that you're bang on. And as an investor, like, you look, there's 3,000 junior mining companies. How do I know which one I should be looking at? Well, when you have the best mining company in the world sort of wanting to be a partner, I think that should be some sort of validation of the opportunity, right? And that's what I tell people all the time. You can take my word for it, but these guys know the business a lot better than I do. Look to them for. And so we chose Agnico. They just, for a number of reasons. One, they're like a great company, top to bottom. They really know how to operate in Canada's north. We share a lot of the same principles from ESG standards and inclusivity standards, all that kind of stuff, which is topical now, but that's kind of always been part of our fabric. And you see that, right? Like, we take a lot of pride in our track record that we've gone from places that have nothing to now, one of our companies, it was called Orex Gold. B2 Gold now owns it. It's the Otjikoto mine. It's in Namibia. That's now like the second largest tax revenue generator for the country. Like, we've changed a country, literally.
Incredible.
Not we were there as early capital providers, right? Without that, people like us taking that risk, these opportunities don't happen. Then you build schools, you build roads, you build hospitals.
Well, I was talking to someone at PDAC, and I said, it's like, obviously people are like, oh, all this ESG stuff now. I'm like, you have no one, like, people don't really understand the mining industry before ESG became vogue. It's a core. It's part of your operating license. You can't just go in there and be like, yeah, mine, I'm going to take it all. You know what I mean? You're working with the communities. Like, it's your license to operate. You're
so right. And you have to have that. If that's not in place, you're screwed. Right. And and people say, oh, mining's bad. The millennium, they're like, mining changes, and when it's done right, could be, a huge, help to economies, to people. Like, you look at these remote areas we've been, and there's never been an area that's been worse off for at least, the involvement we've had in these different areas. And when it's successful, like literally, like towns, like I was saying, are made around these things, right? Like livelihood. Look at Canada. Like, don't forget, it was 100 years ago. There wasn't much around here. What really changed the fabric? What brought a lot of people here? Natural resources. Right now,
resources.
You don't only want to be reliant on that. You want to grow technology and services and whatever else. But when done right, mining is instrumental. Now, to take it one step further, I know we're talking about white gold, but people want to go, carbonless, transportation, all this kind of stuff. Well, you need materials to make that happen, right? You need lithium, you need copper, you need, all these different graphite. So it's important, right? And you can't get to your goal without knowing what it takes to get there. You got to do it right. But, the media and some people just paint it with the wrong brush. That's all, obviously a point of contention I have.
Now, obviously, this is we're touching on white gold. We could go on for we could go on for hours. Now, what in terms of the excitement going forward?
So this is what White Gold had. It's a new company. We've only been around for 5 years. What do? We got this great land package, like I said, almost unheard of. The only other company of significance that was really up there was Kinross, who bought the Golden Saddle, which is the Sean Ryan discovery. We said, guys, this is what we've done. We've got the team that made your discovery. We're here. We're active. Do you guys like this district? They're like, yep. Well, why don't you let us, the guys who know it better than anyone in the world, advance your assets, and why don't we merge forces? And they said, you know what, that makes a ton of sense, right? We want to be a part of this. We lose a little bit of the interest in our direct asset, but we gain an interest in everything else. And so we merged with them. So now Kinross is also a major shareholder in this company. So we're a junior company with two of the biggest mining companies in the world as shareholders. And what that did for us strategically as a company, it gave us a lot of value as we had a known asset. That asset was 1 million ounces of gold, 2+ grams when we merged with them. But we knew there was a lot of low-hanging fruit, and in the last 2 or 3 years with some drilling, we've increased it to about 1.5 million ounces. We acquired another one of Sean's discoveries just to the north, about 10 kilometers. So we're sitting between all that, about 1.8 million ounces of gold, open pittable, 2+ grams. Those are like very, very admirable characteristics for a deposit, right?
Huge.
But so that's good. That's like value that's there. You sleep at night, that's worth something, right? But what gets us excited, what gets people that want to invest in junior companies is it's the blue sky grassroots discovery potential. And that's what we've been focusing on. And in the last 2 years, we've made 2 major discoveries. One's on an untested trend just 2 kilometers west of our deposit. It's called the Ryan's Trend. We discovered the Ryan Surprise Zone. All these Ryans, obviously. You know why? So we now tapped into an ore body that's 400 meters by 400 meters by 400 meters. It's big. It's open in all directions. It's growing. Right to the south of that, last year we had a discovery hole on a target called the Yuli's Ridge. It's like 200 or 300 meters away, 20 meters of 7-gram material. That's like a bona fide discovery hole. We think these things can connect. So we're actively diamond drilling it right now. And I think the opportunity for that to add material ounces to our core resource is very probable. And towards the end of the year, based on the work we've done in the last 2 years and this year, I think we're going to put out an updated resource. A little bit of forward-looking statement here. I think it's going to be well north of 2 million ounces, and that puts us in a class of our own just with that. What's probably the most exciting thing to me right now, though, is our Betty property. That's at the south end of our project. It ties onto the Coffee deposit, which is now owned by Newmont. It's along the same fault structure. We did a first pass diamond drill program last year. We drilled 50 meters of 3.5 grams. And for guys that maybe don't know, what does that translate into? Statistically, holes like that are accompanied by deposit. There's a lot of fluids. It's one of the best holes ever drilled in the Yukon. It's right beside the Betty, which the Coffee, which Sean discovered. It's also just 10 kilometers away from the Casino deposit. That's a 20 million ounce gold, 8 billion pound copper porphyry that's owned by Western Copper and Gold. Rio Tinto just came and invested in about 8% of that company. So we're drilling that. We're doing follow-up drilling that Betty target. And on that same property is another target called the Mascot. Never seen a diamond drill. the anomaly is bigger than the one where we had the success last year. So we have a lot of very exciting drilling that is going on right now. So
man, what a prospective region! What a prospective region! Very exciting stuff, Dave. We could keep. You're gonna come join us for our gold and silver conference. You have to, because there's a lot more to cover here. We're gonna do that in September, but. A pleasure, an absolute pleasure. This white gold, this is an exciting story, Dave. Really appreciate the time.
Yeah, thanks for having me. I'm very excited. Stay tuned. We're gonna have lots of news flow for the rest of the year. I'd be happy to come to your other conference, get to know you guys better. You guys do some great work.
Appreciate it.
Awesome. Appreciate that. All right, Grizzle Commodity Con keeps on rolling. Now everyone has to eat, so we're gonna stop for a quick lunch break. But coming up next is a very special guest. He's probably the most popular rooster on social media. So don't go anywhere because Doomberg is coming up at 12:30.
Boom, boom, we're back. Grizzle Commodity Con. The train does not stop. We've been going nonstop since 10 a.m. And we got a big lunchtime guest. Doomberg himself. First of all, I got to thank our partners. You throw up that slide. We got Kuppy's event-driven monitor. Find the inflection point in your returns and track 20-plus event-driven catalysts with Kuppy's event-driven monitor. You can learn more at kedm.com. Goehring and Rosenzweig, natural resource investor. Respected thought leadership and groundbreaking original research. Visit gorosen.com to learn more. And Doomberg provides salient insights on energy, finance, and the economy at large. Visit doomberg.substack to learn more. Finally, GRZZ ETF, risk managed exposure to growth themes of the future. And without further ado, let's bring on Doomberg. Doomberg!
Hey guys, how you doing? Great to be here.
Man, look at your office. So swagged, man. So nice.
Yeah, we keep a tidy chicken coop.
Oh, man. So just over a year ago, Doomberg landed on Twitter and Substack. I was like, what is this bird? Dropping incredible knowledge bombs. A supernova of financial insights. Today, your Substack sits at number 2 among all paid finance publications. And I think you'd stated it's the fastest growing ever on Substack, the platform, in terms of paid. And you've amassed over 100,000 again in 1 year. People dream of this in a decade. You guys, 100,000 followers on Twitter. Who is the green chicken?
Hey guys, so first of all, really appreciate the opportunity to be here. And as you have described it, and as I listen to it, it's kind of still hard for us to believe. It's been a whirlwind year. Doomberg is the work of our lives. We're a very small team. We come from a background of heavy industry, and several years ago, the partners in the firm left industry to start a consulting firm. And through COVID and the changes we needed to make in our firm to respond to the economic dislocation that resulted from our response to that episode, we ended up doing a lot of work in the content creator space, and then some good mentors of ours encouraged us to start our own, and Doomberg was born. And if you had told me 14 months ago that we would have such a phenomenal launch, and I wouldn't believe it. But at the same time, it flows from the fact that this is what we were meant to do. This, writing these pieces is my passion. The team loves it. It's the funnest thing we've ever done. We've put our legacy business on runoff, and we're focusing all of our incremental efforts on building out the Doomberg brand, and we intend to be doing Doomberg for decades to come. And the response from the market validates the belief that if you pursue your passion and you attack it with discipline and you keep a mindset of continuous improvement, you can do it. And so
it's incredible. We were talking before we officially came on. I got to see your great studio there. Just what an incredible time this is, where you're getting veterans, industry experts providing their knowledge, their insights to the world, and just this supernova that is Doomberg. It's perhaps the apex of the revolution that's happening in finance right now. It's just wonderful. Like, it's not gated, it's not walled on Wall Street. Like, was that part of the thinking? Just listen, let's have something that's accessible and incredibly high quality.
Yeah. So the inefficiency in the market for content that we observed is as follows. The sort of old model on Wall Street has been dying a slow death. I think everyone would agree. And then when you look at the new model, which we think is in the very early innings, this is the revolution in the manner in which people learn and entertain, and the distributed nature of that is really just at the early innings. And it was accelerated by the work from home phenomenon associated with our response to the pandemic. If you take the overlap in the Venn diagram of what Doomberg brings, we have strong finance background, which is sort of table stakes for pulling this off. We have the ability to distill complexity and to write and edit and chart these pieces out. And then the third piece that we think makes the combination of all three unique to Doomberg is we have decades of relevant industry experience. And the vast majority of people that have decades of relevant industry experience are still in industry with paychecks and options and restricted stock units vesting. And the thought of engaging on Twitter and writing openly and honestly and bluntly and critically about what's transpiring in the markets is just out of bounds for them. It's not what executives do. And so relative to other finance content creators, that we think that having all three of those, one of the things we pride ourselves on is our ability to teach non-finance concepts to finance people in a language they can understand. But also because of our finance background, we speak their language. And so the objective of every Doomberg piece is threefold. We shall be funny without being silly. We shall be provocative without being polarizing. And we shall teach without being self-indulgent. And that is the brand ambition. Every piece goes through rigorous editing with those three brand ambitions in mind. And the overall brand objective is when a Doomberg email shows up in your inbox, you have the following gut feeling: ooh, I get to read that. And to the extent, and so
this is like, guys, if you're tuning in, this is like you're putting on a masterclass right now for how to get attention and produce incredible quality work. Wild.
Yeah, for anyone out there who's been on social media and is like, man, I want to start writing, like these are some amazing insights from a guy and a team who've already built something special.
Yeah, and I would say our belief is there are no gimmicks. And so the reason it has to be your passion is because it's an enormous amount of hard work. And if it doesn't feel like work and it feels like play, then it's possible. That's the beginning. Once you have the passion and you're willing to put the work in, then our mindset is what is the very best way to do this, and continuous improvement. And I was telling you guys off air, today's a big day for us. Our Doomberg Pro tier, we have a monthly webinar, and we're doing 2 of them today, one in the morning and one in the evening for our subscribers overseas. And the talk we're giving today is called the 5 pillars of any business. And we walk through the key pillars of any business. And then as part of that talk, we let them see behind the scenes of how we built Doomberg as quickly as we have. And just to be brief, the 5 pillars are brand, which we just talked about, channel, technology, operations, and demand creation. And we have a detailed strategic plan for all 5 of those pillars. But the most important thing is we are data-driven and authentic in our desire for continuous improvement. And so we measure stuff, we analyze it, we improve, and we control. Sort of classic Six Sigma methodology. But we think about brand, we think about channel, we think about technology, we think about operations, the writing of the pieces, the producing of the content, and we think about demand creation. And if you have that framework and you're truly passionate about what you're doing, and you have a mindset of continuous improvement, then the sky's the limit. And with today's highly distributed, entertainment and education, real seismic shifts in those markets. There's a real opportunity. And the nice thing about it is it's truly a meritocracy. And the better you do, the better you do.
Which, it's interesting because Doomberg uses Bloomberg and bringing insights to the masses. And for those of us who've worked on the street, Bloomberg has always been a, Bloomberg Messenger. I'm going to PM, DM my, my other portfolio manager, my analyst. I would talk to Scott. What's interesting now is that Twitter has democratized, now that it's almost become, it's obsolete in the sense, where am I going for insights? I'm going directly to Twitter. I'm going on the Doomberg feed. I'm getting the insights real time, and it's open to the world.
Yeah, and I will say, look, the Bloomberg terminal, we love our Bloomberg terminal. We want to be ambassadors to that brand. It is an irreplaceable and incredible reservoir of knowledge and charts and insights. And it's as expensive as it is. There'd be many things we'd cut from our budget before we'd reach down to that level. And I will.
We're right there with you.
Yeah, and I would say, the thing about Twitter, as you're talking about, and God, what an the value for that platform has been wasted by the existing management for sure. Twitter is just really amazing, and you reach a network effect, and so. We get all kinds of tips and insights for our next pieces, and we have experts we can reach out to and DM, and hey, we'll quote you and we'll link to your newsletter if you give us a quote on this piece we're writing, and they're happy to do it. And we layer on top of this a spirit of giving. We're happy to help other content creators. We retweet stuff. We cite them with links. We try to be totally transparent about where we're getting our ideas. And our belief is that the rate of growth of the content creator market far, far exceeds any one particular person's ability to outcompete you. And so as long as you have a great karma, the Grant Williams mindset, as we would say, it really just makes it play. And so when I get a DM from somebody who gives us an article that's a great idea that connects a dot that leads to a piece, it's fantastic. And so once you get sort of big enough on Twitter, you have real-time feedback. Hey, this piece was BS because you got this part wrong. Hey, appreciate that. Or here's why I disagree. The comment section on our Substack now, which is limited to just subscribers, is great. It's clean. It's there's no. If you're going to troll us, you have to pay us, and so that seems to get lots of trolls. But we got plenty of trolls on Twitter, and that's okay. We're used to it. But
that's a line, man. That's a line. If you're gonna troll us, you better pay us. Now that's if that's actually something. You know what? Twitter should institute that, man. We should. Doomberg should be running Twitter. That's what. So Doomberg, that was a phenomenal intro. Like just what the platform. I think we could go on a half an hour talking just about the platform and what you've built with Doomberg. First of all, we want to get your insights on resources. You guys have we talked about it earlier. Just before we went on air, it's incredible how you guys have called so much of what's happening right now, and almost governments continue to make mistakes that play into your thesis, right? So when we think about the Ukraine-Russia war, it's upended global commodity markets. The Western world's response to Putin has actually made him stronger. And this is a quote. I love this. Doomberg's law of combating dictators that have really, really ridiculously firm strongholds on energy. Actions that result in a higher global supply of energy hurt, whereas actions that result in a lower global supply of energy enable. When do world leaders wake up to Doomberg's law first? And what's the optimal course of action to suppress Putin and inflation?
Okay, so one of the dirty little secrets about commodities is it's not even a secret. It's not that dirty. They're highly inelastic. And so price swamps volume. And commodity players make all their money in very short periods of time when shortages occur. And an event happened this week that just proves this thesis. So Freeport LNG exploded, which caused natural gas to not be able to get out of North America. And that, of course, caused the price of natural gas to sink in the US and caused the price of natural gas to explode higher in Asia and in Europe. The owner of that facility, their stock went up on the news, and you might be confused by that. Well, because the rest of their exports are now priced way higher because they're priced on the international market. And so with Dutch TTF at 37 or 38 or whatever it's trading at today versus 26 last week, the rest of their volume that's still online is worth proportionately more, and they're going to make more money. And the exact same phenomenon is occurring with Vladimir Putin. We wrote in that piece that you quoted from that we should be encouraging as much Russian supply to get on the market as possible, and we should be pumping as much of our own as we can while working to decrease demand so that we can crush price. If we crush the price of oil, Putin makes less money. The price volatility swamps our ability to impact his production and who ultimately buys it. The world needs his energy anyway. He's going to be around 9 to 10 million barrels a day. Ask yourself a question. Is Putin stronger or weaker at $25 oil? He's weaker. So the question is, how do you get to $25 oil? You have to have a surprisingly small, but a meaningful surplus of supply. We saw that when oil went negative, at minus 37 famously in March of 2020. The supply imbalances drive huge price swings. This is a price war, not a volume war, and we're fighting a volume war, and we're losing that war. People will get his energy. India will transact with Russia. China will transact with Russia. Saudi Arabia is leaning against the US and towards Russia. That energy is going to find its way to the market. People need it, and it might as well find its way to the market at the lowest price possible. The only way to affect the price is at the margin have more supply. We should be drilling, pumping, and allowing as much of his energy to come onto the market as possible, because we're not going to be able to stop it. The only thing we can affect is price. That's very counterintuitive, and you have to have experience in industry to come to that conclusion. And unfortunately, Our leaders just don't have that experience.
It's second order thinking, right? Like we should have Doomberg in off. Like this is the kind of thinking that gets us out of these minds. But rightfully, and I think in one of your tweets recently, what's coming out is, oh well, let's windfall tax this. They're almost doing everything to make it even worse.
Yeah, we're sitting here. Fed just hiked 75 basis points. Economy's clearly in or on the verge of a recession, and WTI is 118 on the day. Natural gas in Europe is at the oil equivalent of $180 a barrel. Jeez. Who's winning? Who's winning this war? One of the things that I get into some Twitter fights with people about is the strength of the ruble. Oh, that's fake. I can't trade it. That's a fake number. These people clearly have never worked in industry. And by the way, the pointing out the fact that the sanctions aren't working is not pro-Russian. It's actually very patriotic. We would like for the sanctions to work. The ruble is strong because actually the real currency is energy. Our first Doom Zoom Pro call last month for our Pro Tier subscribers was called A Unified Theory of Doom, Life, Energy, and Currency. And energy is life, which is a phrase that we've coined. And your standard of living is literally defined by how much energy you get to waste. Yeah. And that's because disorder is spontaneous and you have to keep pumping in energy. That's why you need to eat every day, why you need to maintain your home. Left on its own, disorder is spontaneous. And we have a limited energy bounty, and that energy bounty defines the total amount of standard of living we can partition across the population. And the objective is to do so in as fair and equitable way as possible. And so energy is the real currency. Currencies overlay energy. And one of the things we've pointed out to people is the currencies of the countries that are net energy exporters are appreciating against the US dollar. The currencies of the countries that are desperately short energy are depreciating. The euro, the British pound, Korea, Japanese yen.
That's right.
The ruble is strengthening. The Brazilian real is strengthening. Canadian dollar is doing just fine. Australian dollar is doing just fine. And currencies overlay our energy transactions in a way to drive the efficient allocation of that energy across society. And as soon as you see the world through calories instead of currencies, you understand what an effective policy response to Putin's aggression would be versus an ineffective one. And I'll just leave you with this last comment.
Yep.
He would not have invaded if we had not given him all of the cards of the European energy future. Like they're shutting down nuclear power plants. And so he's thinking to himself before he gives the go-ahead, they can't do anything to me because I'll just turn off the gas and they'll freeze. Who did that? I don't blame him. Like that's on us. We know who.
Yeah. That's not like that's not Putin's doing, right? And so one question coming to natural gas, LNG, obviously the Freeport fire aside, but the power of how do we fix this and address this? Why are we not having a Manhattan project for global LNG right now? Like we all got together. We addressed in the same light that we've tackled big problems in the past. Why are we not doing that right now? Like putting all our money towards this and driving that price down.
We're doing the opposite, Thomas. We're this morning, Jennifer Granholm's on TV talking about we demand the refiners invest more money, and also we're going to put them out of business in 5 years. Who's gonna invest that money? Right. The European Parliament is working a bill through committee that would remove natural gas and nuclear from the green label. That means that they would be suitable for future investment. These are both, we tweeted we have a lot more pain to suffer before these politicians either understand physics or get removed from office. And let's hope the removal from office is through the ballot box and not through the guillotine.
I don't want us all to have to learn the hard way, but it's looking that way.
Look, we've said this several times. On the path from abundance to starvation is riot. The people will riot. They will not just stand by and miss 9 meals and not be able to feed their kids without grabbing a pitchfork or two. We are playing with the key elements of life. We've said this before. What is the price elasticity of demand for life and who can afford to pay it? The U.S. will clear that market. We won't go without food. We won't go without energy. We will export that inflation. But there's going to be countries that are on the brink today, or below the line, as Chamath would say, that are really, really in big trouble. And you're going to see.
But this isn't below our line, right? We care.
Yes.
Yeah.
It's well above our line. Otherwise, we wouldn't be so passionate about writing these pieces. I'm glad that you guys got the reference. That's a deep cut for you guys.
Oh yeah, we're on Twitter. Come on, let's go.
No, that's it's when you step back and you look at this, you're just like, this is like what. And they do this all in almost this blanket of we're helping to care the world, like touchy feely stuff. But the people that are going to be most impacted are the poorest people on earth.
It's Orwellian gaslighting of the highest order, and I do believe it just derives from ignorance. I do think that John Kerry literally has no idea what he's talking about, and he gets all of his education from the platitudes that he hears at cocktail parties. We like to refer to John Kerry in our pieces as noted scientist, trademark John Kerry. The man has no scientific education whatsoever. And look, you don't need to be a scientist to get this stuff. But if you're going to defy the laws of physics, you'd better at least have some scientific credentials and an understanding of the scientific method in your back pocket. So it's frustrating. We do believe that ultimately we will get to the right place. The path function can be a lot easier.
And so it just picking on that point of till politicians get science, I'm not bullish on that. And the guillotine, how do we get to a place where we say there's an energy problem in Europe? You need to restart the nukes. Like what, nuclear power? Could you talk? You guys, Doomberg has talked in length about that. Could you maybe give us an overview of how we get nuclear back online?
Yeah, and I'm also curious, what would you be watching for to say, I think the tide is turning where there's the political will to start actually building these things again?
Great question. Okay, so first of all, at the highest level, it is literally impossible to decarbonize much of the economy without leaning on nuclear heavily. And our acid test for the seriousness of an environmentalist is their stance on nuclear. The energy payback period for a nuclear power plant is 6 weeks. The energy payback period for a solar facility is 5 years, and the solar facility provides intermittent power, whereas the nuclear facility provides baseload power. Let me walk you through what that really means. If you forget about currencies and you think about energy as your budget, energy is your money. The net energy profit of the producers that produce and harness the primary energy we need to drive the economy, let's just call it 100 units. Per year. We get to spend that. We put some on farming. We waste some by having the Super Bowl. Like we entertain ourselves. We run our servers. That's all spending our energy money. If the payback period on solar is 5 years and you want to replace 1% of your energy, you need to take 5 of your units and invest it today. T equals 0, discounted cash flow, but with energy instead of cash.
Yeah.
It's 9-to-1 for nuclear. So if you take 1% of your energy and start building nuclear plants, you've displaced 9% of your power with that 1%. Versus needing 5% to displace 1. Yeah. It's 45 times better. And people who don't understand that or want to deny that or have their heads in the sand like ostriches, there is a path to decarbonization. If we invented nuclear power today, it would be proclaimed as the solution to all of humanity's problems. There is no technical challenge to decarbonization using nuclear. It's literally just political will. And for whatever reason, which is an interesting thing to discuss, most of the professional environmental obstructionists are oddly anti-nuclear. And I will just preempt by saying anybody who talks about nuclear waste as being a real problem has no idea what they're talking about, or they're just disingenuous.
Yeah. So what do you think about how does natural gas fit in? Do you think if we don't have if there are obstacles being put forth with nuclear, do we see this tandem where, okay, well, we push on the nuclear side, and that may take a touch longer, but is natural gas the near-term fix and then nuclear is the long-term fix? Like, just trying to think how you think if we want this ultimate lower carbon intensity path, and not even mentioning coal, because obviously coal has now become so important in being a bridge here.
Yeah, so the different inputs serve slightly different functions, and not all of them can be replaced with nuclear. For example, natural gas liquids and naphtha from oil are the key inputs into the entire chemical industry, and all of the materials, including the hats you're wearing, ultimately started in a field somewhere and were brought to market from the hard work of the good patriotic people in the fossil fuels industry. So you will never get any of these materials down to zero, and nor should we. So natural gas is cleaner burning. It has some issues, including methane leaks, which we think are totally solvable. Natural gas is great for baseload power, not as good as nuclear, but better than the renewables. And most importantly, we have an abundance of it in the US. And one of the things we've been proposing is we should take back the polysilicon production from China, stick these polysilicon plants right in Appalachia, and make the inputs ourselves. If we're going to invest some of our energy budget towards renewables, we should at least be using that energy domestically that we can produce with hardworking Americans, where we understand the costs and the benefits. And also, importantly, we have strict environmental controls, which are absent in China.
Well, Doomberg, so I covered utilities through the whole, renewable energy push. And what was incredible is that you were incentivizing, you were giving these incentives, and they were basically effectively going to plants in China to build them. It was incredible. It was basically America subsidizing the industry being built in China.
Well, worse than that, we were industry at the time. China stole our intellectual property. They leveraged slave labor. They used cheap, dirty coal, and they put us out of business. And I was in the business at that time. And we just wrote a piece, our latest piece on Doomberg.substack.com. Sign up today. Is called Solar Zugzwang. And basically, Biden just folded to the Chinese. China owns 80-something% of polysilicon production, 97% of ignits, the cells, the modules. If you own a solar cell today, it was probably made with slave labor. And the Chinese have checkmated us. And we're sitting over here, trying to manage the optics and not the results. And this is what you get. And so it's sad. We know the story well. We've written about it. I suppose if we become too close to the truth someday, we might be canceled for having pointed it out.
No one's going to cancel the Green Bird. Nobody. That's
not possible.
Yeah, we'll see. There's certainly going to be efforts. This disinformation czar was pretty spooky, and Orwell was a piker compared to what's going on today. But alas, that's probably a topic for another day.
Yeah, well, Doomberg, this is an incredible conversation. Obviously, we got to have you back on for a deeper discussion about all sorts. We've just kind of touched the surface here. For those who are new to Doomberg and just finding, we got an incredible number of viewers watching, and the knowledge that you're dropping is incredible. If you have not, you need to go to Doomberg.substack.com. You can sign up for the Doomberg Substack, and there's also can you talk about the second tier, just the two tiers? You'll probably give it a better.
Yeah, so I would say if you want to look at what our offerings are and get some pricing, go to Doomberg.substack.com/about. Our about page is our catalog. For $30 a month or $300 a year, you get access to all of our articles, and we write anywhere between 6 to 8 articles a month, delivered directly to your inbox. Our pro tier is $1,200 a year, and in addition to the articles, you get our monthly webinar, which involves a fixed presentation from the Doomberg team and a live and extensive Q&A. We had one this morning. We're having our repeat performance this evening, and it was like 65 minutes of direct Q&A. And you get a VIP email with the Doomberg team, and and we occasionally write a few short notes to the Doomberg Pro tier with some interesting thoughts on breaking news. But the primary benefit of the Doomberg Pro tier is the webinars. But really appreciate it, and it was really just fantastic time, and happy to come back anytime you'll have us.
Yeah, Doomberg, thank you so much. This is such enlightenment, and looking forward to having you back on. Thanks again. That's Doomberg.substack.com. We'll be back very shortly with Superior Gold. Doomberg, thank you.
Thank you, guys.
All right, welcome back to Grizzle Commodities Con. From a chicken back to humans. We're here with Chris Jordaan. He's the CEO of Superior Gold. Chris, thanks for being on the show.
Thank you very much.
Chris,
Great privilege.
I have to say, well, I think we all should be a bit embarrassed. Doomberg's office looked really nice. You know what I mean? I think the next time we're gonna have to upgrade all of our sets. We have to. It's embarrassing.
We have to compete with a rooster or a chicken at least. Yeah.
Oh,
Yeah, absolutely.
Thank you so much for joining us. Excited to hear about Superior Gold. Chris, for those new to the company, could you give us an overview of Superior Gold and your plutonic gold operations in Australia?
Yeah, thank you very much. Once again, it's a privilege. Sorry, you go.
No, I was going to say we're going to throw up an image to help talk you through it as well, but thank you.
Yeah, no worries. Thank you very much. So Superior Gold is a TSXV listed gold producer that owns 100% of the plutonic gold operations, which you can see in the diagram there is located towards the northeast from Perth, about 1,000 kilometers in WA in Western Australia. This includes the plutonic underground mine, the Hermes open pit project, the plutonic main pit pushback project, which is now in pre-feasibility phase, as well as 80% interest in the Bry Basin joint venture with Alchemy. We also hold a large prospective land package with over 644 square kilometers of prospective land along the plutonic Neumeyer gold belt, with several other gold deposits in close proximity to our existing infrastructure. And given the fact that we're long on milling capacity, that's a very important strategic advantage for us insofar as expansion is concerned.
Fantastic. Now, could you outline the growth trajectory of the company?
Yeah, thank you very much. So our growth strategy at Superior Gold is straightforward, it's well defined, and it delivers on three goals. Now, just broadly speaking, firstly, it's to stabilize the operations and the business. Secondly, then to unlock the full potential of the current business in the way that it's defined. And then lastly, and concurrently to these previous two focus areas, to unlock opportunities through the drill bit. Now, the first goal is targeted to put in place a strong base for further growth, therefore delivering safe, sustainable and predictable operations. In this first phase, and that really started last year, in the beginning of last year, we started working to re-establish steady state production from the underground mine. And we were very encouraged to see that return back to positive cash flow from 2021. In addition to that, there were a few near mine resource extension drilling and mineral exploration that started last year. And as predicted, will provide future mining fronts for the business. Insofar as the first goal is concerned, Superior Gold has delivered on this. In 2021, we provided gold to the market of 77,000 ounces, which was ahead of our upper level guidance. And we were very glad to report that we didn't have any impact then due to COVID. The underground production increased over the year. And in fact, in the fourth quarter, we achieved a mining rate of 900,000 tons per annum, which in fact is our target for this year for the underground mine. So then moving on to the second goal, and this is really about building a business of scale and ultimately moving towards producing 150,000 ounces per annum. And this, we believe, will come at a reduced cost and improved cash flow, of course. Now, the goal to achieve the second goal, we really want to break this down in two phases. The first phase is set to see production increase towards 100,000 ounces per annum. And that's what we're going to do by supplementing the underground feed that we stabilized in achieving our first goal with open pit production from a number of near mill past producing open pits. And we went through Plutonic East in 21. Then in 21, we also started Perch, which finished in Q4 of this year. And now we're into main pit deeps, which is really exciting. So in addition, we also have optionality into Hermes South and potentially Pelora, Seaborg, and Central Bore, which are just east of Hermes South over the next 2 to 3 years. In the longer term, it's envisaged that the main pit pushback project will provide access to our to ore that, together with the plutonic underground mine, will provide us enough ore to keep the current 1.8 million tons per annum mill at full tilt. Now, moving on to the next phase, as I said earlier, we're long on milling capacity. In fact, we have a fully completed and, in fact, operated for a number of years CIL circuit that could run at 1.2 million tons per annum of oxide ore. That will provide us access to an additional 50,000 ounces of production and ultimately take us to that 150,000 ounces level. Now, that ore can either come from our own properties or external properties, or potentially a combination thereof. So this year is really about taking the first steps on delivering on phase one of the second goal. As I said, we're going into main pit deeps, and we hope to see that grade increasing from typically 0.6, 0.7 grams per ton on our previous open pits to up to as much as 2.5 grams per ton.
Oh, wow. Okay.
So, and in addition to that, as I said earlier, we achieved in Q4 last year 900,000 tons per annum on an annualized rate. The underground mine is in fact set up to deliver 900,000 tons this year. So it's up from 835,000 tons last year, 900 this year, but with an exit rate, we're planning in the fourth quarter of this year of 1 million tons per annum.
Okay.
Now, all of this together, we believe will put us in a good position to deliver on our guidance of 80 to 90,000 ounces for this year, with an exit rate of 100,000 ounces in the second half of this year.
So it's all ticking the right. It's all ticking the right way in terms of. And I've got a good. There's a graph that in terms of gold production, just obviously piggybacking on the key points that you've made here. We're looking at the last 8 quarters. We're seeing a meaningful improvement in the gold production. Could you help us understand, just the drivers? Obviously, you're laying out the future path here, but really, this is a pretty this is an impressive improvement in the mine that you guys have really initiated.
Yeah, thank you very much. So overall, we've definitely seen that steady improvement over the last few quarters. Now, whilst the first quarter of this year was softer, we had to do a planned shutdown. It's the first time in 30 years that shutdown was done on the mill. We've completed that successfully. And in fact, that's part of one of the pillars that I'll speak about a little bit later on how we're going to ultimately deliver our strategy this year. We still remain very confident we'll hit that 80 to 90,000 ounces guidance for this year. Now, the quarterly production has increased steadily from the second quarter in 2020, and we expect that specifically the second half of this year is going to be significantly stronger as we use the first half to set up these projects to ultimately deliver to that level. Our cost guidance, if you look at those numbers, are in fact quite conservative. The reason for that is in Western Australia, which was really the last area within Australia that opened their borders, we were expecting, quite a significant increase in COVID cases, which did happen. It did have an impact in the second quarter of our operations, but we seem to be able to hold the fort insofar as managing the impact of COVID. Additionally, as we ramp up to this 100,000 ounce per annum in the second half, we expect to see our costs to reduce, which is very important for us. Yeah. And that will ultimately come through fixed cost dilution. And the other important thing I want to call out here is we're very encouraged by the fact that if you in fact compare our all-in sustaining cost in Q4 of FY20 with Q4 in FY21, we were able to reduce our cost by $267 per ounce. So certainly looking forward to the
very meaningful.
That's like the opposite of where everyone else we see where they're going.
Yes, but to be fair, all right, so we're starting off from a bad base, all right? So there's a lot of work that we need to put into it.
Yeah.
The fixed cost structure is set up to mill 3 million tons per year. And, we were bobbing around at 1.5, 1.55. In the second half, we want to see that increase because we've done the work on the mill. We're going to have the ore. We're going to really push the limits on the current mill to see, how hard we can push it. Okay.
And so with respect to the underground, and I guess this really piggyback on that, with respect to the underground operations, you talked about opportunities for margin expansion and resource extension. Maybe you could drill further into that.
Yeah, sure. So we have significantly improved our understanding of the ore body as a result of an innovative approach to ore body knowledge. And I'll expand on that a little bit more. Now, using this innovative approach and applying latest resource modeling technology, we are able to more accurately define the spatial positioning of the ore. Now, you might ask, so why is that important? Well, this ore body is extremely complex. It is highly convoluted. It goes all over the show on the underground. It is not, as you would think in your mind, it's just this, angled ore body that just extends to depth. We've got major mafic overthrust and so forth. I'm not a geologist. I'm not going to go into that, but we had to think differently in the way that we define the spatial positioning of the ore, because that's really the first start. So we converted to this new block model that we developed over the last 18 months, and we were able to mine 55% from reserve and 100% from the resource grade shells in the first 4 months of this year. Now, that's a marked improvement. If you think the previous 5 years, we only mined between 8 to 12% from reserve, which means we only found gold that was initially defined in the block model of 8 to 12%. So moving from a block model which was highly questionable to a block model now which gives us much more favorable and reliable results. Wow. Certainly puts us in a position to better set up the underground mine, to develop it, and to drive costs down.
That's and that really is like that's some implementing a solution that basically finds you a better pathway to bring that ore out, right? And it's a huge thing, right? And for those who don't, underground mining is it's tough stuff, right? It's wrong moves can dramatically change the course of production and ore grade, and the idea that you guys have tightened the operation to optimize is incredible. Now, the final bit here, which I think is always a test of a real good gold miner, is are you growing your resource through the drill bit? And Superior Gold is clearly doing that. Could you help us understand the exploration upside in Plutonic? We got a chart here just showing how you guys have really increased reserves and resources through the years. It's an incredible chart.
Yeah, no, thank you very much. So when we initially acquired the asset, we had about 200,000 ounces in reserve and just short of 2 million ounces in resource. So we recently released our mineral reserve and resource update, and that was effective December 31st last year. Now, a few key highlights is that our proven probable mineral reserves increased by 66%, up to 630,000 ounces of contained gold at 3.5 grams per ton, which significantly points towards a significant increase of life of mine, which was one of the major challenges that we dealt with. The second one is measured and indicated mineral resources increased by 2% to 1.92 million ounces. The inferred mineral resource increased by 29% to almost 4 million ounces of contained gold at 3.8 grams per ton. Now, that points towards a significant inventory for the future to continue long-term production for Plutonic. I think the last thing here that I'd like to call out is, we further refined the geological model and utilizing this three-dimensional modeling technology that we've recently introduced. Now, looking forward, we've got 644 square kilometers of land package with multiple targets, both to the east and the south, as well as within the underground. Our underground drilling continues to add resources and reserves and outlines new areas of mineralization. And to name a few, the Western Mining Front, Baltic Gap, Eastern Mining Front, and now more recently Indian Axis, which in fact was an area where none of the previous owners, in fact us in the beginning, couldn't find any gold. But it's through better understanding and interpretation of the mineralogy and the geology of the mine, we were in fact able to find the gold in that area. And we've had intercepts of 58 grams per ton over 2.7 meters. So we're really looking forward to pulling those ounces into our production. So that's for the underground, but we're also looking at open pit targets. So Pelorus, Seaborg, and Central Bull. We've just finished the drill work there and waiting for the final results. In fact, if you look at our spend, last year we spent 3.7 million. This year we're spending between $7 and $10 million on exploration. So we're very serious about exploration, and we certainly believe that this is going to not only create a long-term pathway for production for Plutonic, but also will open, hopefully, other ore bodies on our property so we can start feeding it into the second mill.
Chris, fantastic overview, and look forward to having Superior Gold join us for our gold and silver conference that we're going to do in September. Thank you so much for a phenomenal overview of the company and the opportunities ahead.
Yeah, thanks, Chris.
Yeah, thank you very much. I really appreciate it, guys.
Appreciate it. Guys, stay tuned. The show continues. It keeps going. Guys, if you are enjoying what we're doing right now, hit the thumbs up, do the subscribe, do the retweet. We have a copper miner, polymetallic, Sierra Metals up next. Stay tuned. Welcome back, Grizzle Commodity Con. The trade keeps going. Guys, if you are enjoying the content that is being served up in a fun and digestible manner, please hit the like, the thumbs up, the subscribe. We appreciate all that. And we are joined by one of our long-standing companies that we've loved in the space of copper, Sierra Metals, Christiana Papadopoulos. Thank you so much for joining us.
Thanks for having me.
Yeah, no. We first of all, for those who don't know Sierra, could you provide an overview of the company and the key assets? And we got a good little visual here to help talk you through that.
Sure. Sierra's a mid-tier producer. We're diversified, and we have 3 operating and producing mines. Our end product is sold in the form of concentrates. Our largest mine, located in Peru, is the Yaracocha mine. It's our polymetallic mine. So we mine 5 different metals from there: copper, zinc, lead, and a small percentage of silver and gold as byproducts. Yaracocha contributes about 70% to the company's overall revenue. Bolivar is our copper mine located in Mexico in the state of Chihuahua. The mine also produces some silver and gold. And in 2021, Bolivar contributed about 24% to the company's revenue. And then at Bolivar, we also have iron ore in our tailings. So we're now conducting engineering studies to potentially add another revenue stream there through the addition of an iron ore processing plant at the mine. So that's an exciting development. And lastly, our smallest mine is our silver producing mine, Cusi, which is also located in Mexico. Cusi makes up for about 10% of the company's overall revenue. So that's about summarizes each of the mines. So overall, our production is in copper, zinc, lead, silver, and gold as byproducts.
Yeah,
that was really helpful.
It's a great mix of commodities, especially the copper side of it. Now, you guys, could you talk about your green metals exposure? Sierra Metals has with respect to those metals has an interesting angle on green metals. Could you talk through each of the components and how just how investors get that green metal exposure vis-a-vis Sierra Metals?
Sure. Being a polymetallic company, any investor would have access, or I suppose exposure, to the company producing those green metals. We're a strong producer of zinc, having produced 10.5 million pounds in Q1 of this year. It's what we've traditionally focused on at Yaracocha. It accounts for about 24% of our 12-month trailing revenue. But as we focus on growing our copper production, you can see on the pie chart on the slide you had up earlier that our copper production takes the lead in our 12-month trailing revenue chart with 37%. We mined 6.3 million pounds in Q1 of 2022, and we'll continue to see that number increase as production at Bolivar increases. And then lead, also a key metal in battery production, makes up for about 9% of our revenue. We mine lead out of Yaracocha mostly, given it's the copper and zinc and lead concentrates there. And we produced about 4.2 million pounds of lead in Q1 of 2022.
And so, just on the zinc side, in terms of the green aspect, that's through alloys, right? Like zinc is used in alloys. Maybe you could give a little bit of a understanding of what the green angle there is for zinc.
For sure, it's used as an alloy as well as in a ton of our daily products that we use, but
yeah, of course, yeah.
We won't go there.
No.
But yes, it is used as an alloy, and in the production of e-cars, etc., we'll see a zinc maintain its demand for sure.
That's right. Like, so that aspect of lightweight, and you're getting that, and then obviously copper goes without saying, the importance of copper, and it just continues to be harder and harder to find. That's one of the big stories of copper, right? It's grades have continued to decelerate globally, and we just don't. The resources just aren't as we haven't been finding as much copper as we once have.
That's right, and demand will just continue to increase given the green, the forging, our sort of future generation into a green economy. So
yeah, like the one thing I like to say is that obviously people talk about there's the natural lithium, when you talk about battery metal, but one of the best value plays is just copper, right? And copper is truly like, that's almost the main artery vein in the electrification EV play, right?
Absolutely.
It's now with respect to the growth trajectory, we got a good slide here for Sierra Metals in the coming years. Could you talk through what the key aspects of because it's a pretty meaningful growth trajectory over the coming years. Maybe you could talk through just how Sierra is planning out that growth.
Sure. You can see our current permitted capacity at Yaracocha is 3,600 tons per day. And our permit also allows us a 5% over allotment. So essentially we can produce up to 3780 tons per day. We're currently focused on meeting that maximum capacity and are working on permits now for our next growth stage of 5,500 tons per day by 2027. At Bolivar, our current target is to get operations to a level of 5,000 tons per day by the end of the year. And looking ahead, we may examine a low capex option to add a mill to the plant that we already have on hand to get to 6,000 tons per day. That's a potential option for 2023. And then going forward, you can see the chart there beyond 2027 that we hope to get to 10,000 tons per day at Bolivar. At QC, again, our smallest mine, we're currently producing at a rate of 1,100 tons per day, and we'll continue mine development to target 1,200 tons per day at QC. And you can see that QC is sort of missing from that last bar. Yeah. And that's just reflective of our last year's strategic review, where there was potential for diversification of the mine. We weren't sure if it would be with us in 2027, so we left it off of that graph. But at this point, it's producing well, and we are still targeting that 1,200 ton per day target.
And Christiana, just to confirm, right? So when I think about Kusi, that's that gray bar. It's not like it's dying, right? That's just your conservatism to say beyond that time frame. It's not. It potentially, if it's divested, it could not be. But the mine will still be producing in that time frame.
For sure, it's going. Production is going well, and it's actually been a very positive mine for us this year. So
great. Yeah, that's it. We're going to touch on that now.
Yeah.
Actually, so now COVID was a challenging period for Sierra Metals operationally. Could you talk about the pivot that's happening right now and the turnaround in the operations? Because I think this is really an important moment here for the company. Obviously, COVID was hard for a lot of companies, and right now, the key things that are in place and the pivot that's happening for the company.
Sure. I mean, we finished 2020 quite well given the shock of COVID-19, and we headed into 2021 with a very solid outlook. Given our COVID protocols, they were all successful. We were able to maintain operations and protect our workforce as well as local communities. But unfortunately, it sort of became difficult to keep up with some of the other factors we're seeing affecting the workforce globally. Staffing became an issue simply because we didn't have the personnel available. And as a result, drilling became like a backlogged, and that meant that mine development fell behind as well. And production, as well as the quality of the ore being mined, was impacted specifically at Bolivar. And with our turnaround program there now, we've implemented the right management team. We have full staff. We've put in processes to ensure that every aspect of the mine is running to standard. We've implemented steps and controls to ensure that results follow. And we guided for about 6-month timeline to see those results. We're already approaching the end of June, so we should see an improvement in our Q2 production results. And in fact, for our annual guidance for the year, we sort of divvied that up into an H1 and H2 category. And so we'll see production generally increase and target our guidance of 79.5 to 89.7 million pounds for the year. And we'll see us approaching that target more strongly in the second half of the year.
Great. Now, at the Bolivar mine, Sierra now has access to the Northwest Zone. Could you talk about that and the importance for the coming quarters?
Sure. Our throughput for the last few years came mostly from Mina del Fioro, which is also known as the El Gallo Zone, and about 40% also came from Bolivar West Zone. The Northwest Zone, which is a newly accessed point, as you mentioned, is going to provide us with the bulk of the production for the next several quarters. And that'll support our plan for incremental production increases and improved grades at Boulevard to get to that 5,000 tons per day by the year end. And as production increases, further investment will continue at the mine to correct the drilling and the development backlog amongst other initiatives at the mine. But yeah, it's an important development for us. It'll be a big part of our mine turnaround program in terms of getting the right quality and quantity of ore.
There was an exciting discovery, the Fortuna high-grade zone at Yanacocha. That's a very positive development for the company. How quickly can Sierra expect to incorporate that within the mine plan? And could you just provide an importance of how important this discovery is just for life of mine and the rest? How important is Fortuna?
Sure. I mean, the timing of the Fortuna discovery was key for the company. It's an area that we've been highlighting for a while as part of our exploration program. It presents a relatively inexpensive exploration opportunity for us because it is lateral as opposed to, exploration and mining at depth. So it's right in the midst of current operations. So it'd be easy and cheap to bring into the mine plan. It's really a no-brainer. And given the extensive process of permitting in Peru, we don't expect to obtain our permit to mine at deeper levels at Yanacocha until at least the end of 2023. So it made sense to zero in on that area in the meantime. We expect to be able to access the ore body as early as Q3, which will help us make up for the reduced production we saw in Q1 as a result of our mine being impacted by that resurgence of COVID. And we'll mine from there and continue with further exploration in the meantime until we can commence mining at depth.
Great. And finally, Christiana, Sierra is unique in the sense that you have among mid-tier copper companies, you offer a sizable dividend to investors. Could you help understand what drove that decision? And obviously, this is a unique aspect of the business that differentiates Sierra Metals.
Sure. I mean, you can probably recall that there was some pre-COVID discussion about returning capital to shareholders in early 2020. And we expected that we would be in a position to return a significant portion of the company's excess free cash flow to shareholders annually. We had initiated a plan to repurchase 15 million in common shares for cancellation, and another 15 million was to be allocated in some form of return of capital by the end of 2020. But instead, by the end of the first quarter, in March of 2020, that plan sort of got postponed due to COVID. So then in January of 2021, the company entered into a strategic review, which was extremely delayed due to COVID restrictions. Investors grew a bit frustrated with the process and the fact that we were unable to provide an update. So it wasn't until October that we announced its completion. And with 76 million in cash at the time and a pretty solid financial position, we initiated the dividend policy of 5 million or 3 cents per share. It isn't a significant amount, and it didn't impact our cash position greatly, but we wanted to return something to investors as a show of good faith and to follow through on what we had stated in early 2020. So subsequent to that announcement, some operational issues came to light at Boulevard, which we're working on rectifying now through our current turnaround program. And it's certainly our intention to continue issuing an annual dividend, especially as our cash position starts to strengthen.
Great. Christiana, thank you so much for the overview on Sierra, where you guys are going as a company. Sure. Obviously, for us, those who follow Grizzle, we are bullish on electric metals, specifically copper, lithium, and Sierra neatly fits into that bucket. What's interesting with the copper landscape is that there's a material discount of mid-tier and small cap players relative to the large cap copper companies, which Sierra is in that deep value bucket.
We've done a lot of work on that in the past, right? So if you want to check out some past videos, we've gone into details on what Tom's talking about.
Exactly. So yeah, you guys can see the work we've done on lithium, copper, and we're gonna have a focused battery metals conference in August as well. Guys, stay tuned. We're gonna take like a little bit of a break here, not a long one. 7 minutes. We'll be back with Pampa Metals. Welcome back. The show continues. Grizzle Commodity Con. Guys, it's been an incredible day of insights, learning, and entertainment. Man, this has been a lot of fun. We got Paul Gill from Pampa Metals. Before we get into it, I want to ask everyone, if you've enjoyed the content that's come through today and you're not a subscriber to Grizzle, do that. Subscribe to Grizzle. It's on YouTube. Just hit that subscribe button, thumbs up. But also, we also have a great weekly. You go to grizzle.com/subscribe. And on Twitter, if you're watching there, please give it the retweet. Paul Gill from Pampa Metals. Sir, thank you for joining us on Grizzle Commodity Con.
Hey, guys. Great to be here.
And those who don't, Paul's very active on Twitter. We've shared time on Twitter Spaces. It's you're a great part of the Twitter,
a student of the Twitter universe.
Yeah, part of the mining Twitter world, which is incredibly small. If you know what I mean, right, Paul? There aren't a lot of we had Keith on earlier. Like, I can literally think I count on my hand the number of the active Twitter participants from the mining community.
Yeah, it's part of the educational aspect of what we're all going through this journey in investing. We're learning so much as we go through. We have to know and trust that there's other people out there going through the same journey. And if we can educate each other as we go through, it's going to just create more information and intelligence when it comes to where to invest, when to invest, and how to invest.
100%.
So Paul, you guys have been busy at Pampa. And so for investors who aren't familiar with the company, could you give maybe a brief overview of your assets?
Yeah, absolutely. Pampa Metals trades on the CSE under the symbol PM and on the OTCB under the symbol PMMCF. We've got 49 million shares out. Most of the shares have been issued at 40 and 45, and the last tranche was 1.6 million at 30 cents. And what we're looking at right now is a very interesting discovery of stockwork veining on our Block 4 project. That is one of 8 projects we have in the company, but that one is now standing out as one that has drawn a lot of attention from geologists from every single angle of the field. So we're really excited about that. We're looking to drill it. Right now, it is winter in Chile. It's a little bit difficult to get in there, but with another few months, we should be able to get on that project.
Now, Paul, you have a great visual in your deck that looks at the geological formations you're targeting. And, of the mineral belt shown, is there one type that has historically held the best resource? Or do they each have their own pluses and minuses? Maybe for people who aren't familiar with mining, you can help educate them a little bit.
Yeah, I'm going to take it back one more step, because it really goes back to plate tectonics. And that is what the driver here is. People have to understand that the Pacific and South American plate are colliding together, and that's creating the Andes Mountains. But in the foothills of the Andes, you have a lot of minerals that are being pushed up through the ground through this tectonic activity, and that has created some of the best mining jurisdictions and mining locations on the planet. And there are several belts. The Domico belt and the Pliocene belt are the two that have been really productive. In fact, 26% of the world's copper comes from Chile. Now, to put that in perspective, only 10% of the world's oil comes from Saudi Arabia. So it's mind-boggling.
Massive.
Yeah, it's so important to understand where the wealth is created in that particular industry. And of course, everyone knows copper is
something
incredible.
came to mind. So 25% from Chile copper, and once you add, if you were to just say electric metals and you add lithium, they're this powerhouse. Incredible.
You're exactly right. And that's why people have to understand where the wealth is created. Okay, there's a lot of noise in this industry, like any industry in investing. People get distracted and get put aside and all that stuff. But Escondida itself is the richest mine in the world. And you have a copper gold mine that is massive. You could see the whole from outer space. But it is in a location in which there is very little environmental damage going on because it is set in this Pampa, which is essentially broken rock that is strewn all across northern Chile and goes into even Peru a little bit as well. So it's a very unique place, and that's why all of the major companies that produce mines or mining materials such as copper and gold are located there. There's 10, 15 of them that have mines or at least investments there.
Wow. So it sounds like one of my questions was, why is Chile such a juggernaut with copper? And it sounds like it's really at the bottom line, it's tectonic plates.
Yeah, essentially that's what the base underlying reason is, and also the fact that there is nothing to obscure what's going on under the ground. Like, you don't have trees, you don't have any other no communities or cities there, and that really helps in really seeing the geology. Now, a lot of mines have been discovered in Chile already. There's a whole stream of them along those two belts that I mentioned. But what's specific to our situation, why we call it Pampa metals, is we're looking for things that are hidden just below the surface that don't have intrusions and don't have outcroppings. So those are where there's probably 200 more mines in northern Chile to find, and we just have to look long and hard to find them. And we think with the 8 projects we have, and especially already very advanced on one, to the point of getting drills in the ground, that's where we want to be.
Now, I want to dig into your strategy, how you think of, what you do with the discovery. So say you have a major gold or copper discovery. What happens next for the company?
Yeah, at this point in time, we've got several different analytical tools that we're using: magnetics, IP, trenching, and all of that. So once we have what we feel is something significant, and Block 4 we believe is going to be significant, we're in contact with many of the majors that are in the industry to say, would you like to come and take a look? And that's an interesting stage, and we've had good response on that. And that is encouraging to me as a layperson, not a geologist. It's encouraging to me to see the response that we've got. Even at PDAC, I practically lost my voice. We had, many groups come by and take a look. What's interesting is that we put out that news. It wasn't really a big hit in Canada, but it was front page news in Antofagasta, Chile. So they know what's going on. It's just going to take time for everyone to understand. And that's why we're here trying to educate the public on where wealth is created, where things are going to happen. And, copper, Chile, growth, that's what we think is going to make a lot of people rich. And I've been there before, so I know.
That's amazing. So could you help us understand what your drilling schedule looks like over the next 12 months? What are the major milestones investors should be watching for?
Yeah, right now we've done another level of samples, because the one area that we've looked at is only one small hillock, I guess you might say, or mound that is poking through the surface. But looking for similar geology and similar magnetic resonance, we found 4 or 5 other ones that are just hidden underneath the surface. So this, and those are 4 or 5 kilometers away. So that if all of them are productive systems and have stockwork veining, that's a very interesting situation. So we're going to drill the first one starting in probably August, September, when the snow is gone from the project. I mean, there's not a lot of snow. It's just a very remote area. And if you have, trucks going up and forth, you want to have, make sure the guys are safe when they go up there. So that's the big situation that we're going to try to drill and find the center of this. Porphyry deposits, essentially after the description of the tectonic plate movement, there also is a secondary situation in which you have lava plumes or porphyries that they're called, and those push up through the ground and they create fissures in the host rock, and through those fissures there's shoots of mineralization that come through. So it cracks the rock, and because gold and silver and copper are materials that melt at a lower point, you'll see those being carried up through the rocks, and then that's what stockwork veins indicate, is this crack and fissure in the local rock that has deposits of these important minerals. So that's we've already found that. Now it's about drilling down to find the heart of that system, and even though it's some of these are kilometer wide or whatever, you can't always nail the middle of it. And once you start hitting into them, you can get these big grades. I mean, we've had companies like Philo Mining have a fantastic run and have drilled hundreds of holes, and in fact have 1,000-meter intercepts in crazy numbers, and they're up at $20. I mean, that's an amazing success, and that's in Chile. And I think that we're going to see mines develop, and we need 8 new mines with all the demand for copper, electric vehicles, and charging stations and all of that coming. The copper is a conductive material we use, so that's the way to be. That's where to be.
And we talked about it earlier with CR, but this is really the demand's not stopping, and we need that pipeline, right? And where Pampa is, all of this needs to come to market.
Yeah, oil is at the highest it's been for a long time. People I hear news stories in Toronto and Vancouver are about the same. Gosh, my gas prices are going up, and I felt it too. Even 2 years ago, I bought into the whole system. I got an electric vehicle, got a Tesla, and I've never regretted that decision, because this is going to continue. Oil is not coming down. The government is going to keep taxing it until you convert. So get on the program. Okay. It's gonna happen. They're slowly seeing increased in percentages of electric vehicles on the road, and that means charging stations are needed, infrastructure is needed. So get ahead of the curve. That's what we're here to do, is to tell you where we think things are going. Now, to just go back a little bit, in 2000, we started a copper company called Norsemont Mining that had some great success in discovering copper in Peru. In fact, we bought that project for about 4 or 5 million from Rio Tinto, developed it for 15 million, 20 million, spent a total of about 70 million, and then sold it for 500 million. But the reality is, if we could have held on to it, it's now a $20 billion project.
Wow.
The wealth creation is just phenomenal. You just don't see that.
Yeah, so there's just a really great demand background in copper that's going to incentivize people to drill with solid pricing, solid margins, because we just need a lot more copper.
Yeah, we need the copper, and we need it from jurisdictions that are going to be friendly to North America, because for our manufacturing sector to recover, we need those materials, right? I mean, Japan doesn't have any materials, for instance. They have to import everything. So they're at a real disadvantage. China is actually getting their hooks into countries all over Africa in order to soak up commodities like lithium, graphite, and all of that. So there's a real play going on here. And so if we can align South America with the North American market, we'll have the ability to keep competitive, because if we don't, we're going to keep buying parts and labor and or stuff that's coming out of China. And that's not going to be beneficial for us long term.
Yeah. Well, Paul Gill, CEO of Pampa Metals, thank you. This has been a super educational background on Pampa and Chile and everything else. So thank you for that, and we'll be watching your successes closely.
Yeah, Paul, thank you so much. Very exciting, and we look forward to keep keep following the story. And then we've got our battery metals conference that we'll be having in August. Would love to have you there as well.
All right, guys, you take care, and great show. I really appreciate you guys doing this. You guys are on the right track. Appreciate it.
Awesome.
Thank you so much, Paul.
Thanks for keeping your voice for us. We appreciate it.
That's right. It's been a busy week for everyone at PDAC. Guys, don't go
Oh,
away.
you can't go anywhere, everyone, because we have some legends in the energy and commodities investing
Legends.
field. Ooh, we're going to have a good conversation coming up to end things off. So get some water, get ready. We're going to have an awesome conversation.
Yeah, Goehring and Rosenzweig, natural resource investors. The finest quality guys. Stay tuned in a half an hour. Welcome back, Grizzle Commodity Con. The train has kept going and going. Guys, thank you so much for joining us for an epic day of commodities.
Ooh, it's been epic.
And we've truly, in our view, these are in the best natural resource investors that we know coming up next. But first, we have to thank our partners that help make Commodity Con happen. Let's bring them up. A big thank you to our partners. Kuppy, KEDM. Find the inflection point for your returns and track 20-plus event-driven catalysts with Kuppy's event-driven monitor. Learn more at KEDM.com. Goehring and Rosenzweig, natural resource investors, respected thought leadership and groundbreaking original research. Visit GoRosen to learn more. GOROZEN.com to learn more. Doomberg, providing salient insights on energy, finance, and the economy at large. Visit Doomberg.substack to learn more. And lastly, the GRZZ ETF, risk managed exposure to the growth themes of the future. ETF.grizzle.com.
All right, we did it. Now it's time. We're ending the conference off with a bang. These are the two investors we turn to the most when we're trying to figure out what's going on in commodities and energy. They've been great friends of Grizzle for a long time. This is Leigh Goehring and Adam Rosenzweig of GNR Partners. Thanks, guys, for being with us. All right, Leigh and Adam, thanks for being with us.
The originals. This is all.
You're embarrassing me. I've got to put on my Goehring and Rosenzweig baseball hat since you guys are definitely have your.
That looks like a classic from that's like an original model. Is it?
It is. It is. It's a little weather beaten, but it's. I wear it all the time. In fact, I never take it off, and I go to bed at night with it on. So that's how much I believe in what we're doing.
Commitment.
Guys, listen. We've had a phenomenal. Leigh and Adam have been great friends of the Grizzle. We've had great conversations. Their insights have been so salient. We're gonna have a phenomenal conversation. We wanted to keep it truly fireside. Have an open platform to hear what you this is the sweet spot for you guys, right? This is the World Series every day.
That's for sure. And World Series, and during the World Series, sometimes they light off fireworks after the seventh inning and things like that. And I suspect that what we're going to see this year is we're going to see some serious fireworks happen in these commodity markets, especially what could very well happen in the oil market in the next 6 months.
So let me tee you guys off. So we have commodity prices soaring across the board, and we're starting to see early indications of a supply response in certain parts of the commodity market. But for viewers that aren't familiar with your views, could you tell us why you think this commodity bull market will be more durable than, say, what we've seen over the last 12 years?
Well, as far as the oil markets, and I was referring to, that's where we're going to see a lot of fireworks I believe, both Adam and I believe, in the next 6 months, is that there are two things that are going on in the oil market. One is that the biggest source of oil supply growth in the last decade, that is the U.S. shales, have now reached a point of we'll be honest, call it exhaustion or near exhaustion, and that we're not going to see that source of oil supply growth going forward into this decade. It's already come to basically a halt. Now, everyone seems to be of the opinion that the shales can go back to growing 1 million to 1.5 million barrels per day, but our modeling says that just can't happen. And outside the shales, there is no growth going on in the global oil markets. So you have these natural depletion problems that have crept up throughout the global oil world, and then you want to throw on top the ESG problems. And what we've done through the ESG movement is that we've basically severely discouraged the global energy business and the companies that operate in the energy business from investing in their upstream businesses. And like, for example, we've written a bunch of really interesting essays. We're going to write another one about what the super majors are up to. And it's interesting. Just look, I mean, their capital spending, even with $100 oil, is still sitting about 50 to 60% below what they were spending back in 2019.
Incredible.
And they're not that much more efficient, right?
No, in fact,
No, not at all.
And what's interesting is that just look at the announcements of what they're doing with their capital flow. They're not investing in their upstream businesses. For example, Chevron announced an acquisition of a biofuel makers, renewable fuels, which is basically goes around and collects used vegetable oil and turns it into biodiesel. And they spent $3 billion doing that. And this company produces 30,000 barrels a day of biodiesel. If they had taken that $3 billion and invested it in the Permian, which they claim to have this huge position, they would find massive amounts of oil. I mean, I think that they would produce close to 300,000 barrels a day with that 3 billion versus 30,000. So the thing is that in all these big wind offshore eastern wind farm announcements, this big leasing sale that took place 6 months ago, Total is in there, Shell is in there, BP is developing their own big offshore wind farms just south of Nantucket and off of eastern point of Long Island. And we're talking about billions and billions and billions of dollars that's going to go into non-traditional upstream capital investment. And the problem is the returns on an energy basis, the energy in versus the energy out returns is so inferior that if they took those $1 billion and tried to invest in their businesses, what they would actually get. And
so this is sorry, Leigh. My question is: so it really does look like this ESG movement is still putting pressure on the big oil companies, judging by their behavior, is what you're seeing.
Absolutely, it's there's no two ways about it. You've had now the better part of 10 years where the rhetoric and the sentiment towards the upstream oil and gas business has been so bad that it doesn't turn around overnight. And so you look at these upstream companies, like Leigh said, they're looking into biodiesel, they're looking into wind and solar, and if they don't feel like doing that, then they're just returning money to shareholders. I spoke with an energy company last week, and they said, what do you figure the cost of capital is for an oil and gas company today? And I said, I don't know. It's infinite. The returns that some of these companies can make drilling a well are really high, and they're not deploying capital doing that. They're returning it to shareholders. So that suggests that the cost of capital is above whatever they're earning on the best wells that they can drill. And the flip side, if they had to go to the market and try to sell $1 billion of new equity into an oil company, I think it would go no bid. So I don't know that there is a cost of capital still for these.
Well, Adam, that's a great point, right? Like, ultimately, in past cycles, obviously, when you have hot commodity markets, you see this plethora, you see deal activity that should be much higher than it is right now. So the combination of them not deploying capital in the ground, plus deal activity being stagnant, you're getting, the market is telling you what's happening.
Absolutely. I mean, not only is there no deal activity, and IPOs and secondaries are still at a 30-year low, not only is there no deal activity, but the cash flow that they're generating is going back to shareholders. They're putting it in dividends and share buybacks instead of putting it in the ground. So it's almost like you have negative IPO and secondary issuances. The oil and gas industry is
that's a great way to put it.
You can't keep capital in.
Because your net shares are reducing. It's not, if the industry's not growing, you're buying back shares. You're giving out dividends.
It's interesting, the numbers that we're talking about and the impact of lack of capital spending is showing up in the actual numbers. Like, here's a good thing that people aren't paying attention to. Back at the end of last year, the IEA, International Energy Agency, came out with their updated their 2022 non-OPEC oil supply growth for the year, and they boosted it to 3.1 million barrels a day year-over-year growth, total year 2022 over 2021. Those are some of the largest numbers you've ever seen in close to 50 years of data collection. non-OPEC oil supply, and already, that number 3.1 million barrels, they've already reduced it down to 1.7 million barrels a day, and obviously it was way too optimistic. But our analysis says that even before taking out what's happening in Russia, we believe that non-OPEC oil supply growth this year will potentially between 500,000 to 600,000 barrels a day. And it's basically a mathematical thing with the U.S. shales. We'll get some growth from that. They're not really growing, but it's the way you look at it, year over year is going to show about 500,000 to 600,000 barrels a day of growth. So the thing is other than that, the world was expecting 3.1 million barrels a day of supply growth from the non-OPEC world, and the most we'll probably get is maybe 500,000 to 600,000 barrels a day. So this lack of upstream capital spending is really starting to show up in the numbers.
So I know you guys look at most sectors of the commodity market. I'm just wondering, they're not all created equal. What's kind of the most attractive, few areas for you that you're spending most of your time? Oil looks like it's one. Are there a few others?
Yeah, well, we wrote a big, huge piece. We put it out as a blog originally back in the beginning part of April about what we believe is going to happen to the North American natural gas market in the next 6 months, basically because of a big slowing of natural gas supply and strong demand. You could very well see the U.S. gas price, the North American gas price that at the time was basically $7 an MCF, converge with global prices, which were basically $30 an MCF.
Yeah.
And that would still be our number one fireworks call if something didn't happen. And what that something is that the Freeport LNG facility caught fire about a week ago, and basically had to shut down. And now it looks like it's going to be shut down for close to 6 months. And that's basically 2 BCF of LNG demand right there. So the market got a gift of 2 BCF a day of new supply for practical purposes.
But has that pushed the thesis out really more than anything else?
Yeah, it's just pushed the thesis out. The underlying the factors that we believe are going to cause the convergence of the North American gas price with the global natural gas price are still all in place. It just got slightly delayed because of that.
Leigh, I just want to let everyone know, guys, this is a profound piece that GNR has put out. You can find that on the website, Go Rosen website, right, Leigh? But this is a real big call, this convergence of the U.S. natural gas price with global prices.
Yeah.
Yeah.
And we're invested in that call as well.
Yeah. And the funny thing is that, for those that don't know Goehring and Rosenzweig Associates, one of the things that we pride ourselves doing is undertaking original research that often comes up with ideas and conclusions that are completely non-consensus and no one is thinking about it. And this is a classic example of a call that we like to make. And what it is, and Adam can talk all about this, but is that we've identified various geological underlying production trends in both the two largest pure natural gas fields in the U.S. that tell us that supply, which everyone just is under the assumption can grow forever, will all of a sudden plateau and begin to decline. So, Adam, you want to talk about that?
I'd love to have Adam talk about that, because that was from your latest quarterly letter. You had some of that good research, right? Maybe you want to expand on that for the viewers.
Yeah, absolutely. And I do think it's so critical. It's such a great example of the work that we do like to do here. And one of the things that I should point out is that it's really asymmetric. And what I mean by that is, if we're right, I think you could have a very violent, sharp move higher in gas prices. And like Leigh said, maybe that's pushed out a little bit here because of the Freeport fire, but the trends that are there are still in place. So if you look on a global basis, gas prices in the rest of the world are very high. They're anywhere between, they got as high as 50, but they call it $25 to $35 an MCF in the rest of the world. And that's because we're short of natural gas on a global basis. Demand has been much faster and much stronger than people realized. As countries, notably in Asia, get richer, not only do they demand more energy, but they want cleaner energy. So that's had this double tailwind of gas demand, and that's really been enough to tighten things so much. Here in the U.S., as recently as a couple months ago, prices were $4 an MCF, so a huge,
Yeah, that's
90% discount, huge discount, and people really don't appreciate the advantage that has given North America, both the consumer and industries as well. And what you see, that chart that you just pulled up there, this is the ratio between oil and natural gas, and a barrel of oil should be 6 times to 8 times more than a MMCF of natural gas, because it has 6 to 8 times more energy content. And so there's sort of a natural pricing there. And you can see for a long period of time, and we could take that chart back farther, that ratio held 8 to 1 between here 98 to 06. And then in North America, all of a sudden, that just completely diverged. And the reason it diverged was the U.S. shales. We doubled U.S. gas supply here. We were running out of gas in the U.S. and then we went from that to a huge surplus because the shales came online. The most important natural gas development probably in the last, probably the last 100 years. Incredible impact. And the question was, you could always ask, why would the price in the US be so much cheaper than the price elsewhere? And the reason, of course, is that if you were producing that shale gas in the middle of the country, or in the Marcellus or the Gulf Coast for that matter, you couldn't sell it into that international market because we had no export capacity. Well, that's changed now. We have 12 BCF a day of LNG export capacity. We're the largest exporters in the world. From being net importers a decade ago, so huge change. But we still had enough gas. We still had enough production coming from the Haynesville and the Marcellus to fill all that. So if you were a gas producer, you still couldn't access those really nice high international prices. But what we've been arguing is what happens if you could? What happens if you get a little bit of spare capacity in the LNG export market? Then arbitrage tells you that you should lock the price in the US with the international price. And if you all of a sudden were to get some of that available capacity, you could see prices in the US move up, and converge with world prices much faster than people thought. And that was really the basis of our call. And so we said, look, why would there have spare capacity? Like, why would that be the case? What could happen? Well, you could either build new LNG export capability, and we're in the process of doing that, but that'll probably be, a year or two from now, or you could have supply begin to roll over. And what was really fascinating to us is here you had this really, asymmetric case where gas prices in the US could triple, quadruple. Now they've run a lot, so closer to triple, but back a month or two ago, quadruple or quintuple. And it's all predicated on there being enough gas in the Marcellus and Haynesville. And yet no one was turning their attention there. No one was actually looking as to how robust those fields were. And so we started to do a really deep analysis of the gas fields in the Marcellus and the Haynesville. We compared them to some of the earlier shale basins like the Fayetteville and the Barnett that had already peaked and rolled over. So it's not like, we don't have any historical examples of this. We have fields that have depleted already. We know what they look like. And in a lot of ways, shouldn't be a big surprise, but they look like a regular gas field. They ramp up, they peak, they plateau, and they roll over. And it kind of looks like this bell-shaped curve, the same way like every oil and gas field has more or less looked since we started developing them. And by applying some of those analysis to the Marcellus, we concluded we might not have a lot of growth there. And in fact, we might start to see the Marcellus roll over. And if that indeed happens, even stops growing, you're going to lock those prices in faster than anyone thinks. And that's basically where we are today.
Wow. That's a very interesting call there. And I recommend everyone check that out because they've done a lot of fundamental work at the well level to get them comfortable to make a call like this on a basin, a huge basin, feeding the rest of the country with gas.
Yeah. And what we figured out there. Sorry,
go ahead. No, I just had a question. Can we bring back that last chart? I just had a question
on the gas,
oil gas ratio. Now this is US, right? This would be WTI relative to Henry Hub. Is that right?
That's right.
Like, how would that look? We can pull that off. How would that look? How would that ratio look for Europe right now if we're going to go Brent versus? Obviously, that would be much lower. Like, clearly, we're seeing a different dynamic in Europe. Maybe you want to talk through that. Obviously, you're seeing this different dynamic in North. That ratio is probably lower than 8, right? Probably quite a bit, right?
Oh no, yeah. In fact, today European gas prices had a big spike on threats of Russian supply disruption, and European natural gas prices actually hit $40 in MCF today. Asian prices actually got to $30 in MCF. So, like Asian prices, in say oil's 120, divide that by 40, that's 3 to 1.
3 to 1. So you're at the bottom end of that.
Yeah, and that's just goes to show you, both in Asia and Asia. So 120 versus 30 in Asia. So the ratio there is basically 4 to 1. That the people are willing to pay a higher BTU equivalent per molecule than contained in a barrel of oil is proof that there's a global natural gas shortage, which we've Adam touched upon, and it's what people really don't understand. And the big natural gas pricing consultants that have been completely taken by surprise with this is that they've got the global gas market modeled wrong. And the way you have to model it is that, and Adam mentioned this, is that it's just not economic growth that drives natural gas. It's the fact that as a country gets richer, their fuel mix changes. They switch over from burning coal, which when you're a poor country, you only have $2,000 of per capita GDP. You burn a lot of coal because it's a very cheap, easy fuel to burn. It doesn't require a lot of infrastructure. You don't even have to store it. You just throw it right on the ground. Whereas there's a lot of externalities that are involved with coal. It produces a lot of pollution. Anyone that's been in China from 2000 all the way to today realizes you go outside and the sky's not blue, it's brown. And the reason it's brown is because of coal, the burning of coal.
Leigh, can I ask you a question? Because something I always wanted to ask. We phased out wood, and I just want to, where do you see coal's ultimate destiny? Is that kind of, is that just a historic energy form that just obviously, like, if we're to look out 20, 30 years, is that something that's just not part of the energy mix because who wants to have those, or do we come up with a technology that sequesters carbon, it's scrubbed to the nth? That's something I always wanted to ask you.
Yeah, that's a very interesting question, and Adam's going to answer it, because you could make a very, very good case that we are at the peak coal, that right, in 20 or 30 years that coal burning will go away, and it really should go away, especially if you're a believer that CO2 is a global environmental problem. But there is a solution, and it's actually really simple. And ironically, there's new technologies that are coming out today, which could very well mean the death knell of coal. So Adam's really up on this.
Okay, excited, Adam. The floor is yours, Adam.
I think that when you consider an energy source, and we've talked a lot about this, and we've talked with you guys about this, and certainly written a lot. When you look at an energy system, we think it's really important that you look at something that's called the energy return on energy invested. So you put energy in to mine coal, to build power plants and stuff like that, and you get power out the other side. And how efficient is that at recycling energy to make more energy? And coal is very efficient. It's like 30 to 1, 1 unit of energy in, 30 units out. Wind and solar are like 5 to 1. So terribly inefficient compared to hydrocarbons like coal. But coal and natural gas are very similar. They're both about 30 to 1. And gas emits much less CO2 per unit of energy. And so, over the long term, and we'll talk about the real solution in the long term, but even in the short and medium term, I think that there's alternatives to coal that sacrifice little to no efficiency, and you get a lot less CO2 out of it. And so that's why we've liked gas conceptually. And there's been times where we've wanted to be invested and times not. But I think that gas is a growing slice of a growing pie. The pie being total energy demand, and the slice being how much goes to each fuel source. So that's great, but it's sort of missing the forest for the trees these days when you have gas prices that are $40 an MCF in Europe, and wars that are being fought with gas being used as a threat, and factories shutting down to produce fertilizers that use natural gas as a feedstock and potential crop shortages, and to look around and say, oh yeah, we don't need coal because we can just burn more gas, I think misses the point today a little bit. So I think coal is getting a serious reprieve here, and how long that lasts will really depend on how long it takes to get capital back in the oil and gas business. But over the longer term, we love nuclear power, and nuclear power has an incredibly high energy return on energy invested. 1 unit in, you get 100 units out, and that's for today's light water reactors. Incredibly efficient, the most efficient source of energy we've ever been able to harness. Very, very, very safe, despite a lot of concerns and fears and stuff like that. If you look at any of the statistics, nuclear power is by far the safest source of power. But it also is getting a lot more interesting going forward. There's all talks of these, what they call these small modular reactors, and we've started doing some work and looking and researching them a little bit, and some of them seem really compelling, including the idea that a lot of that material, a lot of that thick steel, and a lot of the safety issues with today's nuclear power are being addressed by some of the new generation of technologies down the road. So I think
Adam,
that
are any of those commercial yet, or are they all kind of they're building test facilities type of stage?
yeah, they're early stage, so certainly nothing's commercial now. And I mean, as far as these new generation of companies working on things, nothing is commercial now, and some are in the process of building demonstration plants and stuff like that. What's interesting though is, in some cases, some of the technologies that they're talking about using have been deployed in the past and are not, as sort of futuristic as you might think. The issue here really is that the last major stage in new nuclear reactor design is 40 and 50 years ago. We just really haven't put a lot of time and effort into it. So some of this stuff is actually just kind of bringing back old ideas and repackaging them in new ways and things like that. But a lot of them seem very, very compelling. And even on the technology that we have today, the energy return on energy invested is through the roof, and it emits no carbon whatsoever. And I've been really, really, really encouraged to see how people are starting to respond and think a little bit differently about nuclear. It was only 12, 18 months ago that I would tell people this type of a story and they say, well, that's all well and good, but we'll never have nuclear power. And that's not really the case today. I think people are thinking about it. I think, big countries, Europe, the United States, certainly China has a big nuclear build program, but I think that
Adam,
the tide is turning.
on that point on Europe, like this is a full-blown energy crisis, full-blown. I don't understand how they can not avail everything. Obviously, let's turn back the reactors you've turned off. Let's bring things back online. But is there a tipping point in Europe? Because clearly that's the pinch point that can ultimately usher this revolution in the Western world.
Yeah, they could go first.
Yes.
Well, you are beginning to see it. I mean, for example, right after the EU in their taxonomy report included investments in the nuclear power business as a allowable green investment to make. Literally the day after that, Macron says we're going to extend the life of our entire reactor fleet by another 20 to 40 years, and we're going to build 6 new reactors. Wow. And I think that and for example, the Netherlands is extensively studying whether they should basically restart their nuclear power business, and it's brought about by the fact is that they have a beautiful countryside, and they go out there and they see all these windmills, which are real eyesores, and they said, why are we ruining our most natural asset that we have, which is our beautiful countryside. So I think that we are beginning to see a turn, and I think that we are also beginning to understand why the Europeans are beginning to understand how they got into this mess. And it's all based upon renewables. Adam brought up a very interesting concept, which, this whole energy return on an energy invested, in the sense that sounds like something very academic, but it's actually been put into use in Europe, that you can see the results when people don't pay proper attention to it. For example, Germany back in 2011 decided to basically close down its nuclear power generating business. 25% of the electricity in Germany is generated through nuclear power. And so what they basically closed them all down, and they're all in the process of decommissioning right today, and they replaced it with renewables. Well, what happens when you stop generating electricity that has an REOEI of 100 to 1 with power sources that have at best 10 to 1 at best, and probably closer to 5 to 1 when you properly account for intermittency and things like that? You're gonna have to you're gonna be power short. And so it's the whole crisis started because you replaced one incredibly high efficient source of electricity generation with another that was incredibly poor. And there's no coincidence that all these European countries now are making new all-time highs in coal consumption.
Look, it's baffling. Leigh, I got a question for you, just off that. So, energy return on energy invested. We're talking about a material difference between renewables and your standard baseloads that we're familiar with: coal, natural gas, nuclear. One thing, obviously, EROI can't capture is the fact that even though there's an energy return on energy invested in my wind, because it's intermittent, I now have to build more of this capacity. So there's almost like this element of I need actually more spare capacity, which almost doesn't get captured in the ROI.
No, it's hard to find that data. I've recently been searching, and it's very hard, maybe because the industry doesn't want you to see those numbers, that if you take a solar panel and you need the backup battery and you add that in, it looks even worse, but there's not a lot of research on that. I don't know if you guys have had that problem.
No, absolutely. And the way that we account for that is we take all of the energy that's required to back up and buffer a system like that. So we would account for, as far as the energy in, we would account for the energy needed for the battery. Different people do it in different ways, and they get different results. Some people, in fact, when we first started writing about this EROEI, Leigh and I said to each other, okay, buckle up. We're going to start getting all the comments now, and all the hate mail is going to come our way, and, whatever. And actually, what's been amazing is most of the comments we get are from engineers that say you're spot on. I'm working on this stuff and you're dead right. But to the extent that, we've talked about energy return on energy invested for wind and solar, that's as bad as 2 to 1 to 5 to 1 in that range. And people have said, well, I see it in the literature as closer to 10 or even 15 to 1. And so that's probably, a good opportunity to mention. That difference is the battery. It's the redundancy that you have to build, and it's the battery. And then it's also a little bit of cherry pick data by the industry. They pick sort of an idealized wind turbine blowing at the perfect location and extrapolate that for what wind to replace all of electricity would look like. But of course, it couldn't all be ideal. But by the time you get the actual results of a windmill or a solar panel, which is probably 9 to 1 or 6 to 1, and then you factor in the redundancy in the battery, that's when you get down to that 2 to 5 to 1 level. So we account for it right at the beginning. Other people look at it separately, separate it out. I mean, I think that to me, it's more illustrative to put it all together.
Yeah, you got to put it all together if it's ever going to be baseload capacity, because you can't run baseload on something that's off half the day or however it works.
No, that's exactly right. And for some reason, people forget that. This is a fairly major limitation. When people say, "Well, what's the biggest hurdle here?" Is it the sun sets? But people don't really factor that in.
No. Now, I just had one last one on the nuclear. What do you think gets nuclear going in the U.S., say, versus other places? Do you think they just follow Europe's lead and it gets them comfortable? Or do you see they start permitting some test projects and that's our first inkling that this is going to happen? Or is it going to come from the top? You'll have the president make some pronouncement and that kind of kicks things off.
Well, do you want to take that, Leigh, or you want me to take that?
Well, that's an interesting question, Scott. Is that it's not clear where the impetus is going to come from, but the tide is turning, and the sentiment tide is turning. And obviously, is proof of that is you look at the Diablo Canyon nuclear reactor in just north of San Francisco. That's a big one. It's 2 units, 2,000 megawatts. The governor of California has staked his political career on closing it down for reasons that aren't clear at all why. And he was adamant that it was going to happen. And all of a sudden, he woke up one day and he said, "Okay, if the government gives me $6 billion for new investment to extend the life of the plant," and basically what they're going to do is they're going to have to build cooling towers because they basically discharge the warm water in the Pacific Ocean, which, mind you, that they've been doing now for close to 30 years. It has had absolutely no impact on any environmental impact on the marine life there. But they've decided they're going to spend $6 billion building these cooling plants. But they said, if the U.S. government gives us the money, we'll keep the plant open. So that was a big, huge retreat by the governor on his opposition to nuclear power. So now, does it come from above? A new administration comes in and says, we're going to really kickstart the nuclear power generation building in the United States. It's not clear, but we'll just have to wait and see. But Adam was talking about this whole modular reactor thing. We've studied it, and they one of the things that we're big believers in, and this is why we're so against renewables, is and even EVs, is that historically you cannot displace an old technology with a new technology that has inferior energy returns on energy invested. There's numerous examples over time of people trying to do it, and you just can't. And however, one of the interesting things about these modular reactors is that not only do they have a lot of interesting features that make them quote unquote safer, and mind you, nuclear power is among the safest power generations that there is. But these not only have features that make them safer, but they have energy. They have superior energy efficiency than the old nuclear power plants. So they're going to be adopted, and it's just a matter of time and a matter of trying to overcome this inertia that we have here in the United States.
Mm-hmm. Leigh, you brought up an interesting point, and I wonder whether there's a graph that idea that through time, almost the advance of humanity almost needs a higher EROI, right? I wonder, if we went back to wood, it's just interesting to even just graph that. And this would be the first, in the last 20 years, the first step down in incremental EROI, where you've added just wind and solar and all this sort of things. And almost it's all coming to roost right now. You may not have felt that reverberation, but it's all come to roost. Like you can't have a better standard of living with lower EROI.
Yeah. No, that's exactly right. And here's some interesting data points about the EROI. The Chevy, obviously there's a car shortage going on right now in North America, brought about by supply chain problems, chips, things like that. And obviously it's being evidenced in used car prices being incredibly strong and things like that. And yet Chevrolet just announced a $6,000 price cut on the Chevy Bolt EV. And in a period where gasoline prices have broken through $5 a gallon and there's a car shortage, why would Chevy all of a sudden be forced to lower the price of the Chevy Bolt by $6,000? The reason is no one wants it. Why? Because its competitor, which would be a compact car of similar size, has much higher energy efficiency, and even at $5 gas. And so the thing is that it can't sell unless the government subsidizes it or outlaws the internal combustion engine. It can't sell. Now, here's another funny thing about how important this EROI is that obviously because of the energy crisis in Europe, and obviously so much of the replacement power is now coming from renewables with an energy return on an energy investment of 5 to 1, which is basically what you get from burning firewood. Is that there's all these stories anecdotally in Germany where people are heating their homes with firewood. And so the thing is that like I said, this is not an academic concept.
So it's all come full circle, right? It's all come full circle.
It's come full circle. It's come full circle.
We've turned our back on the last 350 years of energy progress. And look, I get it. I get the concern.
So do I need to basically the new world? I need to kick my kid up and say, listen, put some wood into the fire. Dad's sleeping right now. You wake up at 2 a.m. You throw some logs in.
Well, but that's But Thomas, that's like, for example, if we were to go over to the perfect renewable world that was based on solar and and windmills, is that's exactly what we do. You would send your kids out there to chop down the tree in your backyard and burn the wood in the stove, because it's the same energy. It's the same energy return on energy invested. And so you're like Adam said, you're stepping
Wow.
back 350 to 400 years.
Incredible.
And no one understands the significance of this.
No, so we're still in that phase where people are learning the hard way, right? Unfortunately, and so we're all trying to educate everyone to see that it's not so clear cut that I'm going the green route. It feels good. It's just going to solve all our problems. It's a little more complicated than that.
Well, all we have to do is accept nuclear, because that's a solution. That it's a technology. Even the old technology has incredibly superior energy return on energy invested, and it produces no CO2.
Yeah, that's huge.
Oil. Maybe touch on oil in Russia. I'd love to kind of cover that topic. Obviously, a clear call on natural gas makes the thesis makes a ton of sense. Just wanted to get your overview on what the oil market looks like coming 12 months. Very tricky time right now.
Yeah, and it's interesting. In the beginning part of our podcast, I brought up the idea that we would see fireworks in global commodity markets at some point before year end, and I think they're going to emerge in the oil market. And the reason is there's a couple very interesting trends that have emerged in the oil market that absolutely no one. There's one person out there that's Mr. Rothman over at Cornerstone certainly is, that's commenting on these trends, but no one else is. And the idea that I would say there's something wrong in the global oil market. And what I'm referring to is that since the beginning part of this year to today, step back here a second, the first half of every year sees it's just cyclical, seasonally cyclical. You see a big build in global inventories of both oil and refined product, and then the second half of the year, those inventories are drawn down. And the difference between demand at the bottom of the buildup cycle and the demand levels at the bottom of the drawdown cycle is about 2 million barrels a day. And what's interesting, in this period of seasonally low demands where we should be building inventories, we are not building inventories. In fact, if you're accounting for the releases from the various SPRs, the Japan, European, and US SPRs, oil inventories are still falling. And the thing is, so even with 1.5 million barrels a day of SPR releases, we can't get inventories to grow. And the funny thing is that when I say there's something wrong, and I suspect there's two things wrong. One is that global oil demand is running much, much stronger than anyone cares to admit. And that's why you basically have incredibly strong gasoline and diesel prices today. I don't think it's a refining shortage. I think it's just the demand is running off the charts, and we've underestimated the amount of demand that's related in this post-COVID global economic rebound.
So I have a real question, like how obviously where oil sits today, and just it seems surprising that we haven't seen a step back in demand. Where do you think? I guess the question I'm curious, at what price do you start to see material demand destruction?
That's a good question. Adam's done a lot of work, and he fields all these questions all the time on that very same subject.
Perfect.
Well, the first thing I'd say is not yet. Definitely not seeing it in the numbers. Demand remains extremely strong across the board for refined product, for jet fuel, things of that nature. Demand is very, very, very robust. There's been what a lot of people like to do, and I agree, is to look at what percentage of GDP goes towards either energy in total or oil and gas in particular, and see at what point in the past did that really lead to a lot of problems. And the last major time where oil and energy put a brake on the economy was back in 2007, 2008, and at that point you had oil was about 7.5% of GDP, something like that, and total energy was like 10 or 11% of GDP, and you're nowhere near there yet. Particularly if you look at the U.S., I tend to think that looking at the U.S. in that case is probably the most important um, country to look at. And why do I say that? Well, if you think about a country that uses a lot of energy and probably will have its marginal unit of energy bid away by other countries if we have a really tight market, it should be the US, in the sense that, we could probably tighten our belts a little bit easier. So to get that in US terms, you're talking about $150, I think to $170, somewhere in there, crude oil prices. That strikes me honestly like a bit high. I think probably 150 would be enough to really, really make things very, very difficult. Now, just because that's the sustainable price that it takes doesn't mean you can't spike the price higher than that. And so, could you see $200 oil in the right set of circumstances? Absolutely. But I don't see how that wouldn't put a huge damper on the economy. So I think, it's a little bit of art and a little bit of science, but I think looking at how much of productive GDP goes towards energy is really important. And if you think about it, it gets back to that EROEI a little bit, right? EROEI talks about how much of the energy system is actually going towards generating energy. The rest, of course, goes towards the economy for growth. And so it stands to reason it's a little bit connected to the idea of how much of the economy is going towards generating the energy needed for the economy. And once you start to divert too much of the economy's output in the form of dollars towards just fueling itself, you literally, I say the word stall, but I mean, you literally stall. You're spending too much of your fuel generating your fuel. And so things begin to break down. But we're not there yet. I think probably $150.
Great.
Anything else? Yeah,
guys,
man, we covered a lot of road.
This is an incredible. For those new to Leigh and Adam's phenomenal work, guys, we can't thank you enough for all the great insights. We'd love to have you guys. We're gonna do a focused energy commodity con as well. Goes without saying. I would love to have you guys keynote that and for those following, it's in the description on YouTube. You guys can go to gorosen.com for all of this phenomenal insights and analysis, and it's free to everyone.
Yeah, exactly.
Now, it's interesting, before we leave, and I know that you guys had a lot of questions on supply, and we talked a lot about the supply of gas and the supply of oil. But here's another supply situation that's emerging that's not getting very much attention. Obviously, we're very, very bullish on copper on a long-term basis, and copper has been resting here in a trading range over the last year, basically between $4 on the downside and $4.80, I think, or close to $4.90 on the top side. And we've written extensively about what we call the problems of copper supply. And what's so interesting is we're beginning to see that now. Data points emerged. It's very interesting. It's gotten almost no comments. Is that, remember, Chile supplies about 25% of the world copper supply, mine supply, and Chilean copper production for the first quarter of 2022 is down almost 8%. And it's interesting. It's a combination of everything. It's a combination of water problems. It's a combination of grade problems. It's a combination of civil unrest in the mines. Some of these mines are having blockades put in place, but it's primarily geological issues, which is something that's very, very important that people are only beginning now to understand. So copper is another one of these commodities. It's obviously incredibly important for economic growth, especially in places like China and India. And even though China consumes 50% of the world copper supply, we believe that they got to consume a lot more if they want to go to have a per capita GDP of $15,000 to $17,000 per person. But the thing is that there's the problems that we've written about as far as copper supply looks like they very well may be emerging right in front of us.
And we gotten the first taste of that in the first quarter, it seems like.
Yes, yeah, it was a first quarter phenomenon, and we've written, for example, we wrote a great essay. I guess it was probably about a year and a half ago on a history of the depletion issues that surround Escondida, which is the world's largest copper mine, and all those issues that we talked about are now coming to grip the entire Chilean copper industry. And like I said, it's 25% of world supply.
Incredible insights.
Yeah, that's one we'll definitely want to track then too. We'll look for your future research on that.
Yep.
Leigh, Adam, can't thank you enough. Can't wait to have you guys on again. Everyone, thank you so much for joining Grizzle Commodity Con. It's been an incredible day of insights. And
if you're watching, if you gave us a like, if you shared, thank you guys so much. We wouldn't be able to do this without you. We got a ton out of this. We love doing these conferences just because you learn so much about the companies, the investors, where you should put your money. We do as well. That's why we do this. So thank you so much for tuning in. If you want more insights like this, Grizzle does that on a weekly basis. Probably the easiest way to connect with us is on YouTube, Grizzle Media, subscribe, or you can go to grizzle.com/subscribe. We have a weekly macro piece and a weekly piece on anything that's whatever is important that's going on in the economy.
Yeah, and do subscribe to our YouTube. We're obviously going to have a ton more conferences coming through in the coming months. When you subscribe, you'll get to see that. Can't thank everyone enough for staying tuned through a phenomenal day of commodity insights across the spectrum. We did vanadium, copper, lithium, oil, nat gas, nuclear. Go. Guys, thank you, and we'll do it again very soon.
Yeah, thanks for tuning in, everyone. Have a great day.